Good morning. My name is Neel Kashkari. I am president of the Federal Reserve Bank of Minneapolis. On behalf of all of my colleagues at the Minneapolis Fed, welcome to our 2025 Regional Economic Conditions Conference. We started this conference 6 or 8 years ago as an annual kickoff every year to bring in experts from around the 9th Federal Reserve District, which is Minnesota, North and South Dakota, Montana, the Upper Peninsula of Michigan, and northwestern Wisconsin, to bring in experts from around the region to talk about their outlooks for what's happening across our 9th Federal Reserve District. You know, at the Minneapolis Fed, our job is to represent this district in the nation's monetary policy process. So every 6 weeks, I go back to Washington, D.C. to participate in Federal Open Market Committee meetings. Part of what I'm doing in those meetings is talking about what's happening in our local economy so that ultimately the FOMC can make the best possible monetary policy decisions for the country as a whole. And so events like this are key ways for us to get insights from experts all around our region that we then just complement with the national data that we look at every day. So I'm excited to be here today. We have a great lineup at the 2025 conference. We always start off our conference by bringing in a senior expert from around the region. Sometimes we have political leaders from around the region, and many times we have executives from the private sector, and we have one of those today, a real leader. Today, I'm joined by the CEO of CHS Corporation, which is CHS Incorporated, Jay Debertin. Jay has been CEO of CHS since 2017. Many people may not know what CHS is. It's a huge company that is a little bit under the radar, but is absolutely vital to all of our everyday lives. It's a very large agricultural and commodity conglomerate. They have about 10,000 employees. They have about $40 billion in revenue. And they have wide reach into agriculture markets in the United States and around the world, as well as energy markets, being a key supplier of gasoline and diesel fuel and natural gas, liquefied natural gas to customers all around the country. And so I'm excited Jay is here with us. Thank you, Jay. Thanks for being here. The other thing I'll just mention, Jay, last year you joined the board of directors at the Minneapolis Fed. Really appreciate your service. We're always proud that we're able to attract really talented people who have a real keen interest in public service. And so thank you for your service to the Minneapolis Fed, and welcome to our conference.
Thank you, Neel. It's great to be here. Happy to be here.
Well, let's start. We're going to dive in. So I mentioned that CHS has a big footprint in ag markets, has a big footprint in the energy sector. Those are two key inputs to the global economy. At the Fed, we're very focused on inflation. We're very focused on the labor market. I know that commodity prices, ag prices, have dropped relative to where they were a few years ago.
Right.
How is the ag sector today, and what's your outlook for it?
So the ag sector today is in a different place than it has been in the last 2 years in some parts of the ag sector. The ag sector is a big sector, and people in the cattle business today probably are feeling a little better than they felt in past years. But people in the crop areas, which is a lot of the business within the 9th District, is in a different spot and frankly a more challenging spot than it's been in the last few years. But that's the nature of agriculture, and that's the nature of the businesses that we are in. We go through these cycles. I've been in the business for 40 years. CHS has been around for 100 years, and these cycles are kind of a fact of life. They're not easy, they're not fun, but we're in one again. And so agriculture, the crop conditions for agriculture are more challenging as we sit here today, and we're coming off of 2 or 3 really pretty good years.
But so this is just a normal cyclical lull as opposed to anything more dramatic than that? I guess it's hard to know. It's
hard to know, Neel, but I would point to a couple of fundamentals. In the commodity space, we look at things like balance sheets, and how we think about balance sheets is stock levels of commodities and what we're producing and what demand is taken away. And as we sit here right now, balance sheets are pretty full. Crop conditions around the world have been really pretty good these last few years. And while demand is increasing, production is growing too, particularly in South America. And that's leading to pretty full balance sheets. That drives commodity prices. Then in addition, you get all the other things that are in play, right? You get trade and trade issues, and I know we'll talk a little bit about those too. So the conversation gets larger in a hurry, but we start with the fact that we're sitting on pretty good balance sheets of commodities.
Got it. And just one more, I know we're going to get in a lot to talk about on trade and tariffs, which may be coming. One thing that I've always heard around the 9th District since I've been here, now this is beginning of my 10th year here, is farm prices, land values just keep going up and up and up, regardless of what seems to be happening in the commodity cycle. Do you have any thoughts on that?
Yeah, and it's really going to be, interesting to see when we think about how this plays out. Do land prices not necessarily retreat, but do they continue this escalation going up given on-farm income? And particularly, Neel, where I think it's going to be interesting to see is how does it handle farm rents? Because land values, many farmers aren't really interested in selling their land. And while they like to see appreciation, they are just sitting on that asset. Rents are something that is transactional every year. And those rents really have been escalating up when conditions were good. Now, as conditions are not so good, it's going to be interesting to see, do they hold? Do they back off a little bit? Does land start changing hands? Because there's not a lot of variables to give when it comes to how does a farmer or a producer reduce their operating costs. Things like fertilizer can come down some, perhaps. Other commodity input costs can down some, but land and land cost is a big, big expense.
Yeah, it parallels in it. We have a lot of discussions I have with the economists here at the Minneapolis Fed looking at the housing market.
Right.
And in some sense, it's a parallel because home prices over the last 5 years are up something like 50%. Rents took off not nearly as much as home prices. Rent growth has now retreated. Rents are not so much falling, but they're just not growing as much anymore. But we're trying to get a sense of where's the overall housing market going, and it's a complicated picture.
It really is a complicated picture. And of course, there's always, in the case of agricultural production land, there's always somebody else out there that would like to have a chance to rent that land.
Yes. Yeah.
And so that's also in play. What would they be willing to pay? But it's just the dynamics that go with people trying to get through the cycles, and we've seen it before. But frankly, the conditions right now with operating costs being where they are is creating some stress.
Okay, let's talk about a key input into agriculture. Of course, is labor. I've heard about this, since before I got to the Minneapolis Fed. This was true in California, farmers struggling to find the workers that they need. It's a constant challenge for them. And obviously, so a couple questions. One is we care at the Fed, we care about the labor market because it's part of our dual mandate, maximum employment. We're all trying to get a read on how tight is the labor market. Is it getting tighter? Is it getting softer? So I'm curious if you have any thoughts about that, but then let's quickly talk about what about potential immigration changes and policy changes in Washington and how that might affect the ag sector broadly? Yeah,
and perhaps it's easier to talk about this topic maybe wider and then get narrower.
Okay.
Wider. Let's acknowledge the fact that any country needs to control its borders. It's part of the functions of a national government is to control its borders, and you can call it a fence, you can call it a wall, but you need to control the border. And, not but, and we need immigration to handle the labor needs. And we need those. And that's, that's frankly the answer to the riddle. Now we got to work on how to solve that problem. In agriculture in particular, the labor that comes from immigration is critical to our business, particularly in two areas that I would point to. One is what you spoke to in California and some of the western states where kind of specialty crops and things of that nature are still done very much manually. Not in all cases, but many cases manually. And immigration labor many times is the answer to that. The second aspect is the dairy industry, where immigration labor is a big part of their 24/7 operations. And for those that might say, well, but if you could just increase the dollars per hour that you pay, you'd get much more labor coming at you. Frankly, it's a bit naive in some of those sectors that would work that simply. And the immigration is just a big aspect for that. So when it comes to these kinds of issues, it's just imperative that we frankly work to solve them. And Neel, from many of our chairs, the answers aren't that hard. And I think many people in Washington, D.C. know the answers. It's how to get momentum to solve it is going to be the question. And we're hopeful. I mean, we're hopeful that we can get some answers in this next administration. We'll see. But we need both. We need, obviously, borders controlled, but we also need this source of labor from immigration.
And is there anything that your own, CHS is owned by farmers and cooperatives all around the country. Is there anything that farmers are doing now to prepare for potential changes, or is everybody just in wait and see mode?
Well, essentially people, have found their way to solve their labor issues in many respects. And some of them are difficult choices that they probably have made to get labor into their operations. So they've kind of found a place to operate in. It's going to be, the question is, where do we find ourselves in 6 months or in a year?
Right.
Particularly when the talk of deportation is so prevalent. Does that come into the ag sector for deportation? Because, like I say, that labor component is so critical that if those people find themselves being deported, who's to replace them? And I think that's more the question that producers are weighing is, how does this play out? And we don't know the answers to that. We can guess,
yeah.
But we're all kind of waiting to see how does it play out.
Right. And obviously back to monetary policy and back to inflation, one of the key sources historically of inflation has been the labor market and wage gains.
Right.
It has not been over the last 5 years. It didn't cause the big run up, but it's something we're always paying attention to. And obviously, if the cost of inputs to the dairy market went up a lot, then that would ultimately express itself in higher cost of milk. And so that's the challenge that we need to wrestle with.
It does, and either it's going to translate it that way, or it's going to translate into even lower profitability for those producers, and that has other effects.
Sure.
In terms of consolidation and other things that have its own impacts. So the discussion quickly gets complicated. The fortunate part, like I say, is you can go back to several presidential administrations. There were some nice plans put on the table to really get at some of these issues. We're just hopeful that those plans kind of resurface and we can get some momentum.
Yeah. So let's talk about in the ag sector again, one other big topic, as monetary policymakers that we're in wait and see mode on is what's going to happen with tariffs. We know the economic analysis is very clear. If there's a tariff that's imposed on a certain good, we can calculate the likely price effect of that. And that by itself doesn't cause long run inflation. It's just a one-time price change. Where it gets complicated is, does that happen at once? Does it happen over many years? Is there response? Presumably there'd be responses from other countries. And if there's tit for tat, that becomes much more complicated to try to forecast what is the imprint of that on actual inflation going forward. So let's talk me through what tariffs could mean for CHS, for your owners, and for the ag markets in general.
Right, and I'll look at it really from the 9th District because a lot of the ag production in the 9th District is exported. Not all of it. It depends on the geography. Some is processed within the district. Some is put on a barge and shipped down a river. But plenty of it is put on a rail car and shipped to the West Coast and go off the PNW to largely Asia, and within Asia, largely China. So it is a big deal. To us, it's a big deal to the producers within the 9th District. It's a big deal to agriculture in general. The aspect for agriculture when it comes to the trade tariffs that I think is important to remember is, we are an exporter, so the tariff is not on us. We are exporting. The issue that we get hit with is what you identify, which is the tit for tat. And we saw some of that during the last Trump administration in 2017-18, where exports out of this country, particularly for ag commodities, really took a tumble. And so we experienced that. We went through that. That was very difficult on farm income and farm conditions. Lots of special payments were made to farmers to help compensate for that. The additional factor that comes into play for agriculture is if trade flows become interrupted, we have a fundamental problem of what to do with the crop, because we'll grow it again next spring. And that's the way kind of agriculture works. It's not like manufacturing where you can slow plants down and close plants and things like that. The crops continue to come. And if they don't, then we've clearly got really serious situations if we're not producing. And so, Neel, we are really concerned about that impact that's going to come against agriculture, because it's commodity-based. You can go elsewhere around the world and buy soybeans really fast. You can go elsewhere around the world and buy corn really fast. So that tit for tat can work so quickly. So agriculture is one of the first things to be hit. We are a company, we are an industry interested in free trade. We depend on free trade. Unfortunately, trade is not a real popular topic right now, and not by any administration. It's not, but for our industry, it's just vital. So it gets a little lonely to talk about the attributes of trade and why it's necessary for agriculture, but we lean in heavily on it because it's so vital to how this country has a role in helping to feed the world.
Absolutely. Let me ask you this. Let's dig in a little bit more on this, because at a very high level, economists would say, well, why do you care? Why do we care who buys our beans or our corn? It's a global market. And so if China gets, we're in an argument with China, they say, well, they're going to buy Brazil's soybeans, then American soybeans will go to somebody else.
Right.
Talk me through why that matters.
Yeah, and to some degree, there's truth in that. The markets will, at the end of the day, the markets will clear. And that's a kind of a fancy way of saying the markets will work. You give them enough time, and they will work. What agriculture is subject to, or many of the commodities within agriculture is subject to, is natural trade lines. And if you start fighting those natural trade lines, you can, but you're essentially kind of fighting the market. Let me give you an example. We could find a rail car to ship soybeans from Montana down to southern Minnesota to be processed. We could find a rail car to do that, but you are fighting a market where it wants to go on a rail car and go to the Pacific Ocean and then go to Asia.
In other words, it'd be more expensive.
It'd be more expensive. And now, could you physically do it? You probably could physically do it, but the economics just get turned upside down.
Yeah.
And that's the issues that you can find on a wider scale when we would take, say, soybeans off the Pacific Northwest and try to go to Europe with them. Could you do it? Yes, you can. You can get through the canal and you can get up there, but you're fighting a market that really wants to go to Asia. And so those are the issues that commodities find, where you have these natural trade flows that, yes, you can violate them. I'll use the word violate them to some degree.
If you spend enough, you can do it.
You spend enough, you can do it, and markets will react. We saw a little bit with the Ukraine situation.
Yes, absolutely.
We saw a little bit of that where we were shipping to markets we generally don't, but it was due to reasons like the war in Ukraine.
Well, another example related to Ukraine and Russia, of course, is there's big concern when the war broke out, because Ukraine is such an exporter of needed calories.
Right.
That I was hearing from experts saying, hey, this may lead to a famine in Africa if those calories do not get onto the market. Right. And similarly, Russian oil, it seems like it all found its way to the market. Now the question is, what were the profits that Russia was able to capture from the oil that it ultimately ended up delivering? I think the profits to Russia were much lower because they had to go through circuitous routes to get their oil out to market. And so that's an extreme example of what we're talking about.
It is. And, in the ag side, when the war first started, it was one of the contributing factors why there was increased profitability for many people in agriculture, because commodity prices just took a step up more preemptively, but they did. Now, those of us that do business in Ukraine and around the world, that's not the way we want to make money.
For sure.
That's not the way we want to make money. We work with the markets that we have, but the tragedies that came with that was not the way that we want to operate.
Yeah, absolutely. Well, let's shift gears a little bit and talk about the energy market. Yeah. Obviously, energy, we always talk about, headline inflation is our target, which includes everything that a typical American family would need to buy. But we focus on core inflation because it's a better indicator of where we think headline is going. Food and energy are quite volatile, but energy is really important to families, important to the country. Let's just talk a little about what you're seeing in the energy market.
Yeah, so energy also is going through some volatile times. There's, that volatility in energy generally is a little quicker. And we see a little bit maybe more downside, and then it moves, and it just moves a little faster than the long growing seasons allow the ag side to work. So we've seen it before. Today, right now, energy prices are depleted, are depressed in some respects. I think that the thing that I personally think is going to be interesting on the energy side, Neel, is for sure some of the fossil fuels, I think, will decrease over time. I mean, we can talk about the pace of it, we can talk about the time frame of it, but they're going to decrease over time. And we're a big proponent of renewable fuels, so we'll start pivoting more and more towards other directions. I think it's going to be electricity that's going to be the interesting energy product to be thinking about for the future. And if you think just in some of the announcements that we've read here in the district of around new demands on energy, on electrical production within close into the Twin Cities for data centers and things of that nature, that the energy needs for electricity are just compounding greatly on a grid that's not working well, generally speaking, and production that's generally doesn't have a lot of excess capacity. So I think on the energy side, it's really going to be interesting to see what happens on electricity, and because you think about siting new plants, new production, what's the fuel source for those plants? Those aren't short-term decisions or things that you make quickly.
And how about on the fuel side?
So I think on the fuel side, we think about things like gasoline have hit their peak and are coming down. We can talk about the rate of decrease, but we think that definitely is on the backside.
Domestically or globally?
I think globally a little bit too early to tell, but I think it is globally. Domestically, we see the numbers and we see it tipping over. The aspect about energy that I think, frankly, is something to keep in mind. If there's one word around energy strategy the country has had for a long time, that word is cheap. That word is cheap. The truth of the matter is the alternatives that are in place today are not cheap. They're just not. Now, how is that being dealt with today? Usually being dealt with federal incentives, tax breaks, credits, things of that nature that try to make it a bit more equal. How does that play out over time? I think if you give us more time, some of those things that are today expensive will become more competitive. But we're not there today. So how long do the tax credits, the tax breaks stay in place to help equalize those two, I think is going to be a big question. Nobody in the energy industry wants to invest serious dollars in alternatives if your time frame that you're working with is every 4 years. If that's as much certainty you have as just 4 years because of federal government rollover,
right?
It's hard to get companies to invest really significant dollars in new technology. And I think that's going to be a bit of the conundrum that we're going to face about new technology coming into it. But having said that, there will be new technology. We're going to be in a different place a decade from now than we are today. I think more technology, more alternatives will be in place. But that's where we are right now, is none of them are really as competitive.
But they're not just cost competitive, at least wind and solar, because they're intermittent. Yeah. They don't lend themselves to, they can't be baseload.
That's absolutely right. Those are the points that we want to make sure get put on the table as we think about alternatives, is how do we come up with that? And we talked about the data centers and electrical. You can't just fill it with wind. Yeah. You can't. And that's not against wind. It's just the numbers don't work.
It's just physics.
Yeah, the numbers don't work.
Interesting. And the other thing is, when I was at Treasury now 15 years ago, before the financial crisis, my first year I did a bunch of work on alternative energy. Yeah. And I talked to a lot of the top venture capitalists in Silicon Valley who are obviously always optimistic. That's the nature of their job. But they were all convinced that all of these breakthroughs of biofuels, alternatives to corn, cellulosic ethanol, et cetera, they were 2 or 3 years away. It seems like they've all failed. I mean, it's really hard. Breakthrough science is really hard and takes a long time.
Everything you just said is true. And I think the word that comes to my mind in terms of many times of the explanation is they don't scale. They don't scale. The consumption of energy in this country is of such a scale. So just think about your daily life and the fact that you flip switches and you jump into cars and you get gas when you want. And all that is that infrastructure has been built over 100 years, more. And so these alternatives are starting with just really small plots, very small ideas, very small plants, very small operations, how do they scale to be something that can really be an alternative, a significant alternative? I think corn to ethanol has been one that has really scaled up. And I know there's issues and stakeholders around that that have views about that. But you can't take away from that. That has stepped up to be a scalable alternative contributor. To the energy needs. Not a replacement, but a contributor. But Neel, we've been working at ethanol since the 70s.
Yeah.
And so can you make a change? You absolutely can. But the time frame to do that, to get it scalable, to get it to be impactful, is long.
Yeah. Interesting.
At least with today's technology. Again, you give engineers enough time and money, they'll solve a lot of problems. But it takes some time and money.
Now, do you have any thoughts on we talked a little bit about when Russia invaded Ukraine, energy markets and broader commodity markets skyrocketed. It sent an inflationary shock all around the world. And that was one of the contributors to our high inflation, not the driver, but one of the contributors to our high inflation in the US. Remarkably, when Hamas attacked Israel, we did not see that imprint in energy markets around the world. Any thoughts on why that is, and to what extent that US domestic production is providing a cap, so to speak, on global energy prices?
Yeah, I mean, in fact, just to add on to the example that you used, if you think back into the 80s and 90s, if there was even the slightest military kind of rumor, markets moved quickly.
Yeah.
Oil markets moved quickly. Now you have actual attacks, and markets are quite flat. Maybe up a little bit, but quite flat. And I think the fundamental reason the market has realized that producers aren't cutting back due to these facts. They need the revenue. They need to export the product. They cannot shut down their industries that frankly support their populations within many of the big producing countries. And the markets have looked at it that way. There may be a day where the market is wrong and somebody does take an action, but I think that's what's the biggest contributing factor is if you go back to the 80s and 90s and the market really did have evidence that OPEC and others would cut back production due to these facts. Today, there's less evidence of that, and the market is judging it that way. There'll be a time when the market's probably wrong.
Sure.
But that's how they are, and that's why I think you're seeing less. Now, you could quickly give a scenario where the markets would move. You quickly could. But it would take something more than they're seeing today.
Right. Right. The discussion of energy and the discussion of alternatives obviously very quickly touches into climate change.
Yeah.
And climate change is a big, important topic, important to our district. Just how do CHS think about climate change?
Yeah. So I mean, the crop conditions are so important to us, and we can all point to things that are different than the way it used to be or the way people grew up. It certainly for us, it is more than coincidental. It just is. And now, are we as a society willing to make some steps to do something about that? I think the jury is frankly still out in some respects, because none of those steps are terribly easy and not inexpensive. And are we as consumers willing to pay for that and to incur that? By and large, right now, what we've seen is the majority of people aren't. They aren't. Now, we have pockets that people say they will, and they do, and they're very passionate about it. But you think about the contribution of fossil fuels to some of the issues in the environment. Probably the nearest term impact one could do about that is conservation. That's the nearest term impact that you could do. And conservation is just not leading the pack in terms of steps people are willing to take. But it is probably the quickest thing, the nearest term thing, the least expensive thing we could do to do something about it.
And it's not on the table.
And it's not really on the table in the same way. And so that's a little bit, I guess, what's on my mind is what's going on with the environment is hugely important, and it's something that we as a company are focused on and and make sure we got to make sure the company is positioned well for a future that means these are going to be bigger and bigger steps. But we're not seeing enough today.
But let me ask you this though. So take that as a given. What do you tell your owners, the farmers that you work with? What should they be doing? Should they be doing anything different now? How should they be planning for the future?
Yeah, we are, and we're coming at the farmers really from the marketplace, saying the marketplace over time is going to be asking more and more questions about how the food was grown that they are participating in. And it ends up to be at a farm level basis. How was that soybean grown? How was it treated? What was done to it and as it was growing? Same with corn, same with potatoes, same with anything else. And not only that, when you think about the supply chain from a farm in northern Minnesota or central North Dakota to a plate in Vietnam, that's a long supply chain. So to be able to answer that question all the way through that supply chain, I think is the direction we are telling our farmers that's coming. Now, it's not there today. There's a bit of talk about it today.
Right.
But it's not in place today. We think that will be in place at some point as the world just continues to move in a direction of how is my food grown, where is it grown, how is it treated? And we embrace that. We're fine. We're working towards being able to answer that. But it means then questions that farmers themselves will have to be able to answer and have to be able to kind of segregate crops, which starts getting into the area of cost, is you're going to be able to do that through a supply chain. But I think that's the way the world is going. It's not there today. There's more talk about that than there is actual action on that from many parts of the world, but not from everywhere. Europe is definitely moving in that space faster than other parts, and Brazil is to some degree too. But other areas still pretty much are focused on price and logistics.
For sure.
And that's what they're focused on. So it's uneven, which also is not a great environment where parts of the world are kind of moving faster on those fronts and parts of the world are slower.
But what about, what does it mean for farmers, the crops that they choose? Where are farms viable? My impression is, the northernmost parts of our country historically have been harder to grow, but as it warms up, maybe they become more viable. I mean, are you thinking about that geographic footprint at all?
Yeah, it does make an impact. I mean, we're seeing corn grow, further and further north than it used to be. And, perhaps some of that is climate related, but perhaps more of that is seed genetics.
I see.
And just, research that's been done to allow better crops to be grown in more northern climates. So technology, I think, also has played at least as big a role, maybe a larger role.
I see.
In the ability to do that. But nevertheless, we do talk to farmers about those issues and what does it mean for productive land, for yield, when who knows how some of these aspects will manifest themselves of what types of steps are required. And I personally think it's going to make for an interesting environment for people joining this industry to think about how can they help solve some of these issues. Because I think it's just going to be, we know this, Neel, people are going to eat.
Absolutely.
We know that. Norman Borlaug, who was, had a big impact at the University of Minnesota, Iowa, and in Mexico around grain and grain research and particularly in wheat markets to help feed people around the world. He won the Nobel Prize.
He did.
What's interesting that people don't know is he won the Nobel Peace Prize. And he won the Peace Prize because of the fundamental knowledge that without food, you can't start with peace. And we don't lose sight of that.
It's so interesting. I haven't heard that name. I grew up, my father was a professor of electrical engineering, but he was passionate about trying to provide water and power to solve poverty to villages around the world. And a hero of his was Norman Borlaug. So I would grow up hearing about this Nobel Prize winner that my father was so, had such an admiration for. So it's funny to hear you evoke.
Well, I was just reminded, I was on something with Senator Klobuchar, and we both know Senator Klobuchar as a great advocate for agriculture, and she reminded me of him as well. Just people like that did fundamental groundbreaking work that we are all kind of taking as a starting point and trying to grow from.
Absolutely. So let's shift big picture now on just how you feel about the U.S. economy. We've been surprised over the last few years, in a good way, how resilient the U.S. economy has been in the face of our seemingly tight monetary policy. Inflation has come down. We're not all the way back down to where we need to get. We've made a lot of progress. And the economy has remained resilient. I mean, that's a good thing.
Yeah.
Labor market has remained resilient. That's a good thing. Curious how you see the economy.
Yeah, so I mean, I'll compliment you and your colleagues and your work that you have done, because I think you have, for people that said, you can call it soft landing, whatever you want, but that question whether or not you could thread that needle and navigate those waters, I think you've done a marvelous job. And it's not just kind of conjecture. I think you can look at data and support that statement. Now, that doesn't mean every parts of the industry are where they want to be. Clearly, agriculture is in a bit of a cycle. I can't point to the actions of the Fed or anybody else as a reason for that. Interest rates are clearly a new expense for some that, frankly, had been operating without it. But I would put the agriculture side. I think economically, we look at lots of things as being in a really good place, and really a sustainable place. And I look at the actions that the Fed has taken as saying you've called it right, and you've navigated these waters really, really well and arrived at economic conditions with employment being high, job growth being good, interest rates on their way down, and maybe now at a level that looks very reasonable to those of us that borrow money. Would you like lower interest rates? Sure, you would, but there's also a message behind 0% interest too, and it's not a terrific message, I don't think. Now, that doesn't mean you want to go back to years, times of high interest rates, but I think you're just getting in the ballpark where we have the opportunity to really be successful.
Are interest rates affecting CHS investment decisions?
No, I can't say that they are. We still rely on just fundamental cash flow analysis of investments to say, do we think that these investments will perform? Do we think they're strategically located? How do we think about them 10 and 20 years from now? Right. We can't say, boy, they pivot just on the issue of interest rates. They don't.
They don't.
No, they don't. Now, you could give me a scenario where interest rates at a certain level that maybe have an impact, but they don't today. They don't today. We still look at just fundamental good business and fundamental strategic investments to say, will they make sense for our shareholders and for the stakeholder, whoever it be, a customer around the world that they serve.
So it's funny, you just reminded me, 6 or 8 years ago, I did one of these interviews, and actually I was at Cargill being interviewed by their then CFO.
Oh.
And he was a guy named Marcel, lovely guy.
Yeah, he was.
And he said, he still is. And
Dutch, I think, too.
I think so. I bumped into him on an airplane in Europe. He was arguing that the low interest rates at the time were restraining investment because it's spooking people because interest rates are so low. So it's sending a message. So we had a very interesting back and forth where I said, let me understand something. So you're saying if we raise interest rates, you would lower your hurdle rate? I don't understand that. But in any case, I get the point that he was making and that you're making.
Yeah. Like I say, perhaps we can understand where he was coming from. Again, I just come at it, if we are operating with 0% interest rates, we've got other issues.
Yeah. So a big question that we're wrestling with, and we have about 5 minutes left, is what's the underlying productivity environment of the U.S. economy? So one of the drivers that we think about, which caused those low rates before the pandemic, was society's aging, demographics are what they are, productivity was fairly low relative to, let's say, the 90s. And in a low productivity environment, just think about it, there's less demand for investment capital. And so the balance of savings and investment leads to a lower interest rate environment. Recent year or two, it looks like productivity is higher.
Right.
We're not exactly sure why that is, and we're certainly not sure that that's going to be continued. And so a big question mark is, when rates ultimately settle, are they settling around where they are? Are they settling somewhere in the middle? Or are they going to drift back down to where they were before because productivity might drift back down? I'm curious, the ag sector, productivity is important to the ag sector. I'm just curious, how do you all think about productivity?
Yeah, so I'm interested in in your thoughts of how you think productivity will sort out. I can answer your question from the ag sector. we are very much focused on just productivity increases all along the pattern. And that comes from equipment, that comes from better farming practices that, get at some of the aspects that we could have talked about, and that is how do we optimize things like fertilizer and not overtreat and crop protection products on crops and not overtreat. And water usage and not too much water. And
right.
So all of those kinds of steps for us go to the question of productivity. And just in a different way than person hours that some people might define it as. But it's very much of a focus.
Same thing.
How do we reduce it?
For
How
sure.
do we reduce it and yet help feed a hungrier world? And that's, for us, that's the answer to our riddle. More food with less water and less fertilizer.
Yeah.
How do we do that? How do we do that? But agriculture very much focused on that. And it's also, there's this economic driver around agriculture too, is that helps farm income. That helps farm, so you kind of have an aligned interest of how do you get more productivity, how do you reduce the use of inputs and make more farm income. It all kind of goes together. So you just have all these levers aimed in the right direction, I think, with this area. And other parts of the economy, I think, probably look at it the same way. You can look at it from every kind of aspect. How do we keep interest rates right? How do I increase, my performance of my company? How do I make for a better workforce and a more productive workforce? And those interests can be aligned.
Yeah. When we look at what's caused the increase in productivity, there's some different theories. I'm deeply skeptical that it's already AI showing up in the economy. Usually, even when there is a legitimate technology transformation, it takes decades to show up in the economy. So even if the AI hype is real, it's probably not showing up in the aggregate statistics yet. More likely, when the economy shut down because of COVID, services sector shut down, there was a great reshuffling of labor. And people left jobs that were tougher jobs, lower paying jobs, and they were pushed to go find new jobs. So one theory is that we have a much better allocation of labor into better uses than they had before.
How do you think about that longer term, though, Neel? I mean, we know the math of the baby boomers moving out and not enough people coming into the workforce. So if you think about just a smaller overall workforce, at least in the States, and that's why the immigration is kind of a question. How do you think about that longer term? Well,
it isn't obvious that if it was just like a one-time reshuffling, it isn't obvious why that would lead to a sustained increase in productivity, as opposed to I could see a productivity jump, and then maybe we grow at the similar productivity rate that we had before. So I don't know. That's one possibility. There's a bunch of practices changed during the pandemic that I was hoping would be sustained. For example, when hotels were all short of labor, they said, hey, we're not going to change your bed sheets every day. Mm-hmm. I don't know about people watching this or you. Mm-hmm. I don't change my bed sheets at home every day. So why are we changing our bed sheets in your hotel every day? So that seemed like that was a smart labor-saving practice. But most hotels have now gone back and said, we're going to start changing your bed sheets every day. So, and McDonald's and others have introduced kiosks, so you can do self-service ordering. So a bunch of practices changed that's probably contributing to productivity, but is that going to lead to a sustained, prolonged level of increased productivity? I don't know.
Yeah, it's an interesting point that you raise. I think the item to support what you said that came to my mind is automobile dealerships. Remember during the pandemic, lots were empty. People had to order cars. You had to wait for them to come in. We're right back to seemingly, when I drive by car dealerships, full lots, lots of inventory.
Exactly.
It seemed to me that they kind of had a window where they were training us to order.
Yeah.
And maybe they could keep their inventory down. But they've
gone back.
By appearances, they've snapped back to that old way. Lots of inventory, dollars tied up, and so forth.
So anyway, I hope if productivity is sustained at a high level, it'll be good for lots and lots of different things. Grows the pie, so to speak.
Yes, I agree.
And that would probably mean we're going to be in a somewhat higher interest rate environment than we were before the pandemic, but for a good reason. Not because of inflation, just because the economy's growth trajectory is fundamentally stronger.
Doesn't it seem like a stronger environment if we operate in that than if we either had the tails of the bell curve?
Oh, for sure. For sure. I just wish we could engineer that.
Yes,
that's a hard thing.
Yes. Well, I think in some respects, I think you are engineering it. I think the Fed is from my chair, been pretty effective at dialing in this kind of landing point. And now you're talking about very small increments that you're working with.
Yeah, I mean, I appreciate the sentiment. I feel like we are takers, we are recipients of this broader macro environment that we're in, that we're having to navigate around. So if the neutral rate that we debate a lot, if the neutral rate is low, we'll move monetary policy up and down around that neutral rate to achieve our dual mandate goals. If the neutral rate is higher because we're in a higher productivity environment, then we'll move monetary policy around that higher neutral rate. But we don't believe that we can set that neutral rate. We think that we're takers of that neutral rate, and we have to try to figure out what that is, which is imperfect at best.
That's a good point. And I would guess, things like the bond market and longer term interest rates, point of deficits or other things would also be an impact to your decisions.
For sure,
Yeah.
for sure,
Yeah.
for sure. So Jay, this is great. I knew we were going to have a really rich discussion, and we did. I know we could have got on a lot longer, but thank you for being here. Thank you for being so candid with your comments about the ag sector, about immigration, about climate change, about the energy markets. Really great insight and great kickoff for our conference today. So thank you for
Happy to be here, Neel, and thanks for your service.
You too. Thank you for your service. So with that, I'm going to turn to my colleague, Joe Mann, who's going to kick us off here for the next segment. Thanks for being with us, everyone.
Well, all right. Thank you, Neel, for the introduction, and thank you to Neel and Jay for a very enlightening conversation to begin off our program today. My name is Joe Mann. I'm a Regional Outreach Director with the Federal Reserve Bank of Minneapolis, and I'm going to be taking a real brief moment to provide an overview of some business indicators that we publish on our website and that we collect at the Minneapolis Fed. Just a quick level set for the rest of our program today. I'm just going to bring us to the top of the hour before I turn things over to my colleague, Ron Wirtz, who is going to be conducting a panel on the conditions in labor markets. And then Ron's going to turn it over to Eric Garcia Luna, who will be hosting a panel of experts to discuss general economic conditions. But before we get into the expert panel of our program, I'm going to give a brief overview of some of our regional economic indicators that we produce ourselves here at the Federal Reserve Bank of Minneapolis. This is a monthly survey of business conditions in our region that we call the Minneapolis Fed Business Pulse Survey. This is a program we've had running for a few years. I'm just going to kind of give you a brief overview of what the survey is and what some recent results are. And hopefully you'll be interested in an annual economic outlook that we asked our respondents about recently. Before I go any further, just a quick disclaimer, my views are my own and not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So as I said, I'll be overviewing our Pulse survey, what it is and how it works before I get into the survey results. And throughout, I'm going to prompt you all to, if you're interested, to this is a network of contacts that we're continuing to grow and develop, and I'll be prompting you all to consider joining our contact list for this survey as we go on. And you'll find out more about how to join there. All of this information is published on our website, minneapolisfed.org. If you go to our regional economic indicators page under the regional community tab, you can find this information there. This survey is something that we do on a monthly basis. We have a group of contacts that we check in with on a regular basis, and we ask about a number of indicators, business indicators, whether they're increasing or decreasing, and we ask them to just look back over the previous month and compare to the month prior, and to look forward and give us kind of an outlook into what's happening in the near future. And as I mentioned, we publish results on our website. Why is there a large QR code on the left side of this slide that you see right now? The reason is because if you're following along at home and you get interested at any point in signing up to participate in our survey, you can scan that QR code to join our survey panel. We'll also be sharing a link with you in the chat and in the follow-up email that you get. So this is a survey that we conduct on a monthly, but we have a contact list of a few thousand highly engaged businesses representing a number of different industries, firm sizes, kind of everything you can think of, and all of the states in our region. They're all opt-in, voluntary panelists who've decided to join our survey, and we've conducted them from a number of different channels, including in-person speaking events like this, and partner organizations, and a long-running list of subscribers. In some ways, this is a program that we've been building kind of for decades, but it's only been a few years that we've been doing this monthly survey and publishing the results on our website. I won't belabor, in the interest of time, what exactly I mean by our region. You can see the map of the 9th Federal Reserve District here, and I'll be embedding that QR code in the corner of each slide And again, you'll have ample opportunities to sign up after the program as well. So to get right into the indicators, I'm going to have a few charts that look like this. So I'll take a moment to just describe what I'm showing you on this chart. So every month we ask businesses in our survey about a number of different indicators. I'm showing you on this chart sales and profits. I think those are fairly self-explanatory. And we just ask them whether that indicator increased, decreased, or was unchanged prior compared to the month prior. So we conduct a survey at the end of the month. We ask about what happened in the past month and how things went compared to the month before it. So it's a higher frequency look at what's happening in the economy, which is pretty relevant to us at the Federal Reserve. And we do conduct this survey to gather intelligence on what's happening in the real time in the economy. These kinds of efforts are really one of the best sources that we have of getting ahead of the data that are published to tell us what's happening in the economy by connecting with businesses around our region. So the little dots that you see are the monthly observations from the survey, what businesses are telling us. And then the lines that you see is that's a 3-month moving average, which is just a way of kind of smoothing out some of the month-to-month fluctuations. Some of these series can be a little volatile month to month, so you get a better idea of the trends sometimes if you smooth them out. And you can see here, I've plotted these and in terms sort of net share terms, if you're familiar with the diffusion index. Basically what I'm doing is taking the percentage of respondents who've told us that an indicator has increased over the past month, and just taking the difference between that and the percentage that told us it decreased. So we kind of get an aggregate measure of whether an indicator increased or decreased over the past month. You can see that dotted gray line in the middle is sort of the threshold point between positive and negative growth. So anything above that line indicates that on average, the respondents told us that business indicator increased in the past month. Below the line tells us it's decreasing. And you can see the trend if you look at sales here at the beginning of so we've been conducting this survey on a monthly basis for 3 years now. And at the beginning of the period, we were seeing pretty strong growth. And that has kind of sort of tempered over the following years into sort of more level up and down, depending on the month that we asked it. Conditions. What we've seen over the last 6 months or so was sort of negative growth in demand among a lot of the businesses that we survey. We also ask about month ahead expectations. So I'm sharing with you the results of the survey that we just conducted at the beginning of January, asking what happened through the end of December. And you can see that actually their month ahead expectations looking into January at the beginning of the year were fairly positive. They were expecting a pretty decent rebound on average in sales over the coming month. And you can see that reflected in that dotted line. So that's a little bit of a longer winded explanation of what's happening in this chart, because I'll be sharing some more charts that look like this one. Again, sort of weaker growth in sales over the last few months, but positive outlooks heading into the beginning of this year. Investment, on the other hand, has held up pretty well over the history of the last few years that we've been running this survey, and that's remained in positive territory over the last few months. This might be a little bit surprising given the interest rate environment, but businesses are telling us that on average, their capital expenditures have remained positive. Inventories, on the other hand, have been slipping for some time now. So that's just kind of an overview of a few of the indicators of business performance. One of the other things that's really relevant for us at the Federal Reserve, because we have an employment mandate, is to ask about labor markets. And as many people know, over the last few years, labor markets had been very tight. You can look at some of the aggregate data and see that the unemployment rate has come up. They've cooled down a little bit recently, and you can see that in the monthly responses to our surveys as well. So I'm showing you on this chart hiring. That's just whether businesses are continuing to add jobs, and the total headcount, the staffing at each of the firms that are responding to this survey. And what's interesting is you can see at the beginning of this period when labor markets were really tight, we had a really high hiring activity. Headcounts weren't necessarily growing that much, and that's kind of consistent with what you might expect to hear in a tight labor market economy. Everyone's trying to hire, but maybe not being as successful doing it. And what's noteworthy is over the last few months, we've seen some cooling down, actually negative growth in hiring activity and in overall headcount as well. But we see that rebounding more toward neutral over the last month or two. So you can kind of see the sort of quick story of the last few years of labor markets in here. Again, I would just point to that sort of this is consistent with what we're seeing in the aggregate data as well, that there's been some cooling in the labor markets over the last few months. One of the other things we're really keenly interested in at the Federal Reserve is prices and inflation. So we ask about prices, a few different kinds of prices. I'm only plotting two of them here because I think they're sort of most relevant. Wages, obviously, that's keenly, intimately related to the labor market. So we can see wage growth on this chart. That's the sort of light blue line. And then the teal line is showing sales prices. We also ask about input prices and benefits costs. And one of the more valuable things that we get on this survey is open comments from respondents who fill in details on what there's, certain prices that they're seeing going up more than others. Input price growth has been stronger over this period. And again, you can kind of see if you look at the sales prices. So this is prices that businesses are charging their customers for their products and services. And you can see really, really rapid growth over at the beginning of this chart. And one thing I'll note is if you compare the scale on this chart to the ones I was just showing you, throughout the whole history of this chart, price growth has remained positive. And that's maybe not surprising given the inflation that we've seen over the last few years. But we've seen the percentage of firms telling us that they're increasing prices has been steadily trending downward over the last few years, popping up here at the end of the year with some expectations for some price increases in January. And that's maybe normal seasonal variation. So it's useful to kind of look at that 3-month moving average to smooth that out a little bit. Wage growth has remained pretty strong, but that's come down as well. So just a kind of quick overview of some of the business indicators that we ask about in this survey. And the last thing I'll leave you with before I turn it over to my colleagues is at the beginning of the year, we thought it would be interesting to put in some ad hoc questions about the annual economic outlook. We knew that we had this program coming up and thought it would be good to have some material to share on that. So we asked a few different questions. We asked about their outlook for business indicators, all the same ones that we usually ask about at their businesses. Overall, they're expecting growth in 2025. And what's interesting is one of the questions, I sort of broke it down between how optimistic or pessimistic are you for the economy over the coming year. And we asked about prospects for your business, but also for your community in which you're based, your state economy, and the national economy. And what's interesting here is you can see on balance, the survey respondents are very bullish for their businesses in 2025. Nearly 60% telling us that they're optimistic on balance for their business prospects in 2025. A slight majority of them are optimistic for their community's economy. And as you get further away from the business, the level of optimism goes down. Although I will point out, still more than 40% optimism for the national economy in 2025. But as you get sort of further away from home, from their businesses, the level of optimism decreases and the level of pessimism increases. What's interesting, I'll note about this particular question is we did give survey respondents the option to tell us that they were unsure about their outlook or they didn't know or didn't care to respond, and nobody selected that response. So some people are optimistic, some people are pessimistic, some people are neutral, but nobody's unsure, apparently. They all feel fairly confident, I guess, about their outlook for 2025. And again, at least at the business level, that level of optimism is positive for the year ahead. So that's what I have to share with you today. Again, I want to underscore, please do look for these indicators on our website. This is a growing effort that we have. I would love to encourage folks in the audience, if you own a business, if you run a business, if you're a key decision maker, to continue to consider becoming a source. We'll be following up with other opportunities to do that. And stay tuned to our website, because as we continue to grow and expand this effort, we'll be producing more content related to the results of this business survey. So I hope you found these results interesting. And with that, I am going to turn the program over to my colleague, Ron Wirtz, who's going to be leading our labor market panel. Over to you, Ron.
Thanks, Joe. Excuse me. Wonderful job. Really appreciate you giving all that new information. We've been doing it for a long time, but I think to be able to share to a larger audience is really important. My name is Ron Wirtz. I'm a Regional Outreach Director with the Minneapolis Fed. And first, before we get into the panel, I'd really like to, again, kind of reiterate how important it is to get any private company or nonprofit organization that's attending today to consider being a regular part of our survey. You know, nobody likes surveys. We know that. I don't like them. It's in part because a lot of surveys rarely give responders anything in return. And that's what I'd like to just spend just a word on real quickly. And where I think this stuff is a little different. Obviously, the Minneapolis Fed needs your insight. Neel needs your insights. But I think the value proposition here is that we're bringing your collective insights to the entire business community and the general public. So being a survey responder, we hope it's only just a small inconvenience, a small commitment, but then we can amplify that insight and share it with others. So I really encourage anyone that is even modestly interested to hit that QR code and sign up. You can always unsubscribe to that. So we would love to see you be part of our survey. So with that, let's turn our attention now to parts 3 and 4 of this conference. So we're going to host 2 panel discussions now with experts from each of the 9th district states. The first panel that I'm going to moderate will be on labor force trends in Minnesota, Wisconsin, and the Upper Peninsula of Michigan. Each panelist will have about 15 minutes to present an overview of labor market conditions in their state. And we'll conclude at the end with a Q&A session roughly until the hour is up. I'm going to moderate that Q&A session, and I would really encourage all viewers to submit questions to the Q&A box at any point during the discussion. I'll be paying attention to that, and I'll try to get your questions into our panelists. In the interest of time, I'm not going to give long introductions of speakers. I do want to note each of our speakers has really deep experience in this area. And if you are interested in additional bio information, that's available on our conference's online program. So with that, let me introduce our first panelist. That's going to be Angelina Nguyen, who will talk about Minnesota's labor force. Angelina, you can start sharing if you'd like. Angelina is the research director for the Minnesota Department of Employment and Economic Development. Welcome, Angelina.
Thank you, Ron. Good morning, everyone. My name is Angelina Nguyen, and as Ron already mentioned, I'm director of Minnesota's Labor Market Information Office, which is housed at our Department of Employment and Economic Development. My office serves as the data and research function of our state government agency. We work closely with the U.S. Bureau of Labor Statistics, U.S. Department of Labor, to collect, clean, and publish data that track job growth and various employment metrics. So this morning, I'm going to give an overview of Minnesota's labor markets with the latest data available as of November 2024. I would summarize Minnesota's labor market as stable and healthy. Overall, jobs have grown, labor force size has grown, labor force participation rate has stayed high and stable. Wage growth was strong and became even stronger in recent months, and there are still more job openings per job seeker. Now, this description is in the post-pandemic context of Minnesota. And you've heard some of the themes that I'm going to talk about already mentioned in the fireside chat this morning. What the post-pandemic context means is that Minnesota has an older population. We saw a silver tsunami between 2020 and 2022. Lots of people retired. And there's also less net domestic migration now than in the previous decade. So that plus an aging population means that our population growth is slower. It's still growing, it's just lower than in the past. We can think of population change as driven by 4 factors. So 1 is natural births, 2 is natural deaths, 3 is in-migration, and 4 is out-migration. In recent years, Minnesota's ratio of births to deaths has leaned in the direction of fewer births and more deaths. People are having fewer children than they used to in the past. And at the same time, having an older population means that we see more people reach the end of life than we have before. Overall, there are still more births than deaths, but that difference has been growing smaller with time. According to our demographer's office, 2020 was the first year when we saw more counties in Minnesota with a natural net decline than counties with a natural net increase. In 2023, 51 out of 87 Minnesota counties were in natural decline. The other factors affecting population are migration patterns. So Minnesota has seen a bigger decline in net domestic migration in recent years, and that could be explained by retirees moving out of state and young college-age people going to school out of state. In the past, that net negative domestic migration was made up for with net positive international migration. So people from other countries moving to Minnesota to live and work. So the total net migration line that you see has been positive for most of the last decade or so. We saw that line fall below zero in the years immediately after the pandemic, which affects our labor force story today. So in the decade between 2013 and 2023, the whole nation experienced a shift of generations in the labor force. So in 2013, Gen Z was just entering the labor force. The oldest Gen Z was 16 years old in 2013, while baby boomers had just started reaching retirement age. And since then, a big portion of Gen Z is now in the labor force, entered the labor force, and we've experienced a wave of retirements with baby boomers and the workers older than them. Compared to the national average, Minnesota saw a slightly slower increase in the number of Gen Z and millennial workers, and a slightly faster decline in the number of workers from Gen X, the baby boomer generation, and the silent and greatest generation. Gen Z's percentage increase on this chart is really off the charts. To give you a verbal description, Minnesota saw an increase of 1,505% of Gen Z between 2013 and 2023 in the labor force. And that is still slower than the national average increase of 1,836%. So therefore, Minnesota's overall labor force growth was lower than the US as a whole, so 5% compared to 9%. Our labor force is currently a little over 3.1 million people. It has been recovering from the pandemic plunge, but it's still about 30,000 people less compared to right before the pandemic. Labor force participation rate has been hovering around 68% for a few years. Before the pandemic, it was at 70%. So although it's currently lower compared to pre-pandemic, our labor force participation rate is still among the highest in the nation. We rank 6 with almost 6 percentage points more than the national average labor force participation rate. And looking at over the month, we track over the month job growth as well as over the year. Looking at over the month job growth, Minnesota's growth has been generally steady post-pandemic. We recover all the jobs lost, and we have surpassed pre-pandemic job levels. And both the private sector and the public sector have seen job growth. Over the year, job growth for Minnesota trends follow the national average trends, but it's just a tiny bit slower. So, and that makes sense given our labor force age demographics. Our unemployment rate also follows the national average trend, but again, it's lower. We rank 20th lowest in the country for unemployment rates. And my office also keeps an eye on the ratio of job seekers per job vacancy. And again, the Minnesota trend line follows the national average trend line, but we have fewer available worker per job vacancy. Right now, there are still more job openings than there are job seekers. And we've seen consistent wage growth, especially in the last year in the context of lower inflation. As of July 2024, wage growth has been consistent for long enough, and inflation has been low for long enough to have real wage growth for the average worker in Minnesota. Minnesota's average pay per hour still remains more than $2 higher than the national average. And higher pay continues to be one of the methods for employers to attract workers in this tight labor market. And then lastly, I'm going to touch on AI a little bit. With the widespread use of AI, we've been getting a lot of questions about the impact of AI on jobs and the labor market. And it's hard to predict the impact of AI on jobs given how fast things change with AI. We did a research project to explore what types of work are more exposed to AI. And you can see the link there on the slide. We found that Minnesota has a high concentration of employment that's exposed to AI. So more than 1.6 million jobs in Minnesota are highly exposed. These occupations tend to have higher educational requirements and higher wages. So we found that 70% of employment in occupations with the highest exposure to AI have a median wage higher than $60,000 per year. And over 75% of occupations that typically require a bachelor's degree or higher are in the high exposure group. So what's different with AI is, unlike past waves of technological change and automation, which had primarily affected blue collar work, research shows that white collar work is more susceptible to being impacted by AI. So what that means is, while AI has the potential to increase efficiency and drive innovation, there of course is also a lot of worry about widespread job displacement and its negative economic effects. We found that major industries in Minnesota that are poised to benefit from AI include management of companies, manufacturing, finance and insurance, and healthcare and social assistance. But at the same time, these same sectors are also at higher risk of disruption, especially for white collar jobs that have traditionally been considered more stable. So the challenge lies in preparing workers through education, retraining, and support to navigate this transition in the upcoming years. We want to ensure that AI's benefits are broadly shared while also mitigating the risk of economic disruption. So in summary, Minnesota's labor force demographic is different now than it was pre-pandemic. Because we have an older population, our labor force and job growth are slower than the national average. Given what we have, though, our labor market is in as good of shape as it could be, with low unemployment and high participation rates. And we still, as of today, we still have more job openings than job seekers. And thank you for having me. Back to you, Ron.
Thank you, Angelina. Great start to our panel discussion. Real quickly, as I'm watching the chat box or the Q&A box, it sounds like some of you may be having some issues in terms of viewing slides. I just want to remind everybody that we will be sending slide decks to all registrants and links to this entire webinar on a follow-up email. So in the case that you want to have a chance to take a look at Angelina's slides a little bit more closely, you'll have that opportunity later. So thank you. Thank you for your patience with any technical difficulties. So going on to our next panelist, that will be Matthew Kuros, who will talk about trends in the Wisconsin labor market. Matt is a community economic development specialist and a researcher at the University of Wisconsin-Madison. Welcome, Matt. The screen is yours.
Thank you so much, Ron, and thank you to the Federal Reserve Bank of Minneapolis for the opportunity to be with you this morning. Again, my name is Matt Kuros. I work at the intersection of workforce community economic development, doing research and outreach across the state of Wisconsin. And I'm going to go ahead and jump right in and share both some high-level perspectives on overall labor market conditions in the state of Wisconsin, as well as some conditions specific to counties in the 9th District. So I think one of the questions that we get a lot is whether or not we are returning to somewhat of a pre-pandemic labor market. And we can look at this in a number of different ways. And here we're starting by looking at the number of monthly job openings, starting in January 2001, going up through the most recent data we have for October 2024. And indeed, we can see the overall number of job openings has dropped notably since the onset of the pandemic. And in fact, now the number of openings is lower than it was in the years prior to the start of the pandemic. Now, that being said, we do see that openings remain somewhat elevated compared to most of the periods prior to 2018. So in some ways, the openings have returned to somewhat of a pre-pandemic labor market. That said, this trend somewhat mirrors the downward number of openings nationally and likely reflects a number of challenges that businesses are facing related to inflation, interest rates, and broader economic uncertainty. And it also seems to reflect some of the trends that Joe shared in his survey earlier. We can also look at this in terms of the number of monthly hires, and here we're looking at a smoothed average for 3 months, looking at the number of hires that businesses are doing across the state of Wisconsin. And again, here we see hires has fallen as well to under 100,000 per month. The current level, again, is probably somewhat more reflective of what we saw in the middle part of the prior decade, somewhat reflecting what we saw with the job openings trend. And again, this movement also somewhat mirrors what we're seeing nationally. In terms of quits, not surprisingly, the number of quits has also come down since the start of the pandemic, where we saw a very large spike. We do see levels being much closer now to what we saw in 2016 and 2017. And again, this reflects uncertainty with workers maybe not being able to have such much confidence in finding a new job in the labor market, given the number of openings and hires that is going on. And it's also led many observers to maybe say that we've gone from the Great Resignation to the Great Stay, where we just aren't seeing as much churn in the labor market due to people leaving their jobs. Now, uncertainty in the labor market has spilled over to employers as well. It's not just workers. So we can look at this in terms of layoffs. And what we see is that layoffs remain quite low in the state of Wisconsin. And it may be that given some of the challenges that that employers had in hiring during the pandemic, that they're willing to hang on to those workers a bit more, and they simply just aren't as willing to hire them or to lay them off, and even if they're not maybe needed as much on an hourly basis. And certainly we see this in unemployment rates as well. If we look at current unemployment rate in the state of Wisconsin, it is still quite low. It has diverged somewhat from the national unemployment rate, with it ticking up a little bit nationally. But again, if we go back on that trend line and look at where we are now compared prior to the onset of the pandemic, we do see that we are very similar to we were in 2018, 2019 for unemployment rates, and they do remain quite low. If we look at unemployment rates within the 9th district counties, and apologize for this chart, it is a little bit busy, but as Ron said, you will get a copy of this presentation. We do see that most unemployment rates in 9th district counties are below the national average, with Price and Iron being the two exceptions, which have similar rates to the national average. We also see that rates are quite low in some 9th district counties, many of them below 3%. We also see that a number of 9th district counties are below the state average of 2.6% as well. We also can look at the number of job openings per unemployed individuals per job opening. And again, if we draw a line back to where we are now compared prior to the start of the pandemic, we do see a very similar level. We do see 0.64 unemployed individuals per job opening, or essentially 1.5 job openings per unemployed individual, which kind of reflects what we saw in the state of Minnesota as well, is that there's simply more job openings than individuals available. And again, this chart also suggests that we are somewhat returning to what we saw in the pre-pandemic period, which was also a tight labor market in many ways. So we do certainly see some cooling in the labor market, but we also maybe return to a period where the labor market remains similar to where we were in 2018 and 2019. Now, one thing we did see was an inconsistent return to pre-pandemic employment levels in the 9th district Wisconsin counties. Here we're using quarterly census of employment wage numbers, looking at quarter 2 2019 to quarter 2 2024 changes. State of Wisconsin as a whole increased by 1.8% for wage and salary employment. And we do see a number of counties that did tick up in terms of overall employment during this period. But we also see a number of counties that have not yet recovered total employment, including Price, Trempealeau, Florence, Lincoln, and Buffalo being some of the notable lower ones. And I think what's interesting is that the difference in these employment gains and losses are not necessarily kind of restricted to one geographic region. They're not necessarily restricted to metro or non-metro areas or in terms of industrial composition. And they reflect a variety of factors that have occurred in these different counties in terms of impacts on employment. Now, that said, we can also look at many of these counties having an inconsistent return to pre-Great Recession employment levels as well. So if we look at percent change in wage and salary employment going back to 2006 to 2019, prior to the start of the pandemic, many counties, including Buffalo, Price, Ashland, Rusk, Florence, Taylor, Lincoln, and Washburn, also lost employment during this period, and then in the period from the pre-pandemic to the current recovery we're in now. And that speaks to the fact that many of these counties are also facing structural issues that were not necessarily brought on by the pandemic, but were partly due to other factors in terms of employment availability and employee availability in these counties. I think one other factor that we can think about in terms of challenges to employers hiring is the increase in monthly business applications and whether or not employees that may be potentially working in these businesses may have changed their employment prospects by starting a business. And initially, when the pandemic hit and we saw business applications spike, we initially thought that this was due to many businesses wanting to file for PPP or other incentive programs from the federal government and simply not having an EIN to do so. Now, we've seen these rates remain quite elevated since the onset of the pandemic in terms of both total applications and high propensity applications, or businesses that are more likely to become employers going forward. And we don't just see this statewide, we see this across many counties in the 9th District in terms of business formation rates increasing. So we're also having to think about whether or not individuals are more willing to take on the risk of starting their own business rather than going down their traditional wage and employment salary path. Now, one of the structural issues that we mentioned before that's been well documented is a falling working age population in the state of Wisconsin. In the past, we've simply looked at how this has trended going back to 1970 up through current estimates that we have. But this chart now incorporates recently released population projections from the Wisconsin Department of Administration. We thank them for putting these out. So we can also now look at what changes might look between 2020 as well as 2030 and 2040. And certainly we know that Wisconsin's working age and prime working age population have come down over the last several decades in terms of total residents and in terms of percent of the total population. In fact, between 2010 and 2020, Wisconsin's working age population declined by roughly 28,000 individuals. However, between 2020 and 2030, it's projected to drop by almost 215,000 individuals between the ages of 15 and 64. Now, that said, these changes occur quite differently across the state of Wisconsin. If we simply look at changes in total working age population and prime working population on a county by county basis from 2010 to 2023, the darker the blue, the higher the percentage loss. The counties in orange are those that have gained in population. We certainly see that most Wisconsin counties have lost total working age population as well as prime working age population. In fact, only 12 Wisconsin counties grew in terms of total working age population from 2010 to 2023, and only 2 Wisconsin counties grew in prime working age population from 2010 to 2023. Now, moving forward in terms of projected changes from 2020 to 2030 in Wisconsin 9 district counties, here we're seeing populations 25 to 54, the prime working age population. We only see a handful of counties that are projected to grow in terms of prime working age population. Again, with many Wisconsin counties in the 9th District seeing significant projected losses, with counties including Forest, Florence, and Rusk leading the way. In terms of total working age population, we also see a similar trend here. Eau Claire is the only county in the 9th District in the state of Wisconsin that's projected to grow in total working age population. And again, we see significant declines projected across the state of Wisconsin and most Wisconsin 9th District counties. The flip side of this is the change in population age 55 and older. As we all know, the 9th District and the state of Wisconsin are getting older. Just to put some numbers on this, Wisconsin added almost 283,000 individuals aged 65 and older between 2010 and 2020. Between 2020 and 2030, it is projected to add another 283,000 individuals of this age group. So the share has jumped from 12.3% of our population in 2010 to a projected 22.8% by the year 2030. Now, in contrast, we see the share and number of individuals aged 55 to 64 looking to decrease. However, this is simply due to this age cohort moving from 55 to 64 to the 65 and older age group, which also means that these individuals are transitioning from working age to retirement age. And if we look at the percent of employees age 55 and older as a percent of all employees in 9th District counties, we can see that most counties have at least a quarter of their employees age 55 or older. We see a slightly smaller share in Dunn, St. Croix, La Crosse, and Eau Claire counties, but even in these counties, we see almost a fifth of those employees approaching retirement age. We also see a projected increase in many counties in the 9th district for individuals age 65 and older. The entire state of Wisconsin projected to grow by 26.7%, but much larger increases in counties like Sawyer, Florence, Pierce, and St. Croix. And even in Buffalo, Rusk, and Pepin counties, we see notable increases. That said, those smaller increases are simply due to the fact that those counties already have an older population. Individuals 15 to 24, so our younger potential employees in the state of Wisconsin, 20 to 24, in terms of total numbers, is projected to be somewhat flat between 2010 and 2030. 15 to 19 is expected to come down somewhat. And this is an important age group because this is an age group that actually saw their labor force participation rates increase from the pandemic forward and actually picked up a lot of the slack in terms of employment in many Wisconsin counties as well as the state of Wisconsin as a whole. Now, the other question I frequently receive is regarding Wisconsin's foreign-born employment and how they contribute to the overall labor force. Now, we don't necessarily have good information on immigrants or the foreign-born population, especially at the sub-state level, but the U.S. Census Bureau's American Community Survey does serve as one starting point for discussion. It does not say how these individuals entered the U.S. and includes naturalized U.S. citizens, non-citizens, U.S. nationals, lawful permanent residents, temporary migrants, and unauthorized migrants. Now, as a whole, if we look at the foreign-born employees as a percent of total employees in the state of Wisconsin, it's about 6.6%, or about 200,000 workers. And we can certainly see how it varies across different industry sectors, with the highest shares being agriculture, forestry, and fishing, high shares in manufacturing, and somewhat lower shares in retail trade, wholesale, and finance, insurance, and real estate and rental and leasing. Now, in terms of foreign-born population by county, we don't have good information in terms of the share of employment on a county-by-county basis in the 9th district, but we can look at the share of foreign-born population as a percent of total population. And what this map does is split counties up into quintiles, or 5 different buckets that contain 20% of the U.S. counties. And we can see that for the most part, 9th district counties are in those bottom 3 quintiles in terms of the share of population that is considered to be foreign-born, with much higher shares found on the coasts as well as some of the border states throughout the United States. We'll end by talking briefly about labor force participation rates. And we have again seen the state of Wisconsin's overall labor force participation rate come down really over the last 2 decades. That's primarily due to the fact that our population is aging, and as older individuals leave the labor market or have lower participation rates, it pushes down our overall participation rate in the state of Wisconsin. That said, if we look at participation rates for different age groups, we tend to have some of the highest participation rates of any state in the country. And if we start by looking at prime working age men, or men aged 25 to 54, we can see that Wisconsin had 89.3% participation rate among this demographic. And we can see that many Wisconsin counties in the 9th district had higher participation rates than the state average, with a handful below the national average as well. So overall, for the most part, we do see high participation rates for prime working age men. A very similar trend for prime working age women. We see only a handful of counties below the national average, and many counties in the 9th district being higher than the state and national average for prime working age women. For our younger age groups, we also see notably high participation rates. We look at individuals age 16 to 19. We do see most counties in the 9th district have higher than national average participation rates for this age group, with Barron and Chippewa and Oneida leading the way. And then a similar trend for 20 to 24 participation rates. Most counties in the 9th district have higher participation rates than the national average, again with high rates found in Trempealeau, Barron, and Taylor County being higher than the state average. With that, I'm going to stop sharing, and I want to thank you all for your time, and I'll turn it back over to Ron.
Thanks, Matt. Great job. I really appreciate you taking the extra effort to highlight the counties in the 9th district. They don't always get a lot of attention rather than just statewide data. So I appreciate the extra effort on that. Finally, our last panelist now is Amy Berglund, who will talk about the labor force trends in the Upper Peninsula of Michigan. Amy is the Director of Business Initiatives at Invest UP, which, if you're not familiar, is a regional economic development organization up in the UP and a great friend to the Fed. Thanks for your time, Amy. Screen is yours.
Thank you, Ron. Let's see here. Right. Thanks again, Ron, for the opportunity to join you today. As Ron mentioned, I'm Amy Berglund. I'm the Director of Business Initiatives with Invest UP. I'm going to start with a little bit of an explanation of for Invest UP. We are a 501c3 nonprofit regional economic development organization. We have about 33 members. Mostly private sector, larger employers in the region. We also include our 3 universities, as well as UP Michigan Works from the public sector side. Our mission is to drive prosperity across the region, and we do this through a variety of initiatives based on a number of partnerships and collaborations, which I'll touch on a little bit later. We've engaged over the past several years in a significant amount of research into data pertaining to our population trends and demographics in order to understand where we are now and identify where we need to focus moving forward. We know that as a region, the UP represents 1/3 of the landmass of the state, but only 3% of the population. So we're a very rural region. We have 15 large counties, 352 miles east to west, and 227 miles from the north tip to the southern tip. So plenty of beautiful geography to cover. Our population has been hovering around 300,000 for the last few decades. But as we've seen, and as you can see here on the chart, we've had a downward trend since about the year of 2000, and we're projected to continue on this trend of losing population. Not only have we been losing population, but very similar to our neighbors in Wisconsin, our demographics are shifting towards an older population as well. As you can see, this shift over the years, where we are currently, our largest age demographic right now is the 55 and older, which is concerning for the future of our labor pool. But we have seen some increases over the last year. So some improvement over the last several years in most of our counties. Even though deaths are surpassing birth rates in every single one of our counties. So where are they coming from? When we looked a little bit closer into the demographics, we see that our counties, especially those with a university, are doing a great job of attracting young talent to the area. Houghton County in particular is seeing a gain from other countries, international students and faculty at Michigan Tech, we can attribute that to. Marquette County, which is the home of Northern Michigan University, is also seeing gain from other counties and other states. Our main concern is that with this, upon graduation, more leave than stay, and we'll address that later as well. On to employment data over the past year. If we look at labor force participation rates, you'll see here that we have made somewhat of a recovery, peaking in September of last year, and then coming down a little bit to more of our pre-pandemic rates, pretty consistent with what we've had in the past. Looking at unemployment, we pretty solid and consistent there as well. We don't have December numbers just yet, but we're looking to possibly be maybe 1/10 to 2/10 over last year's average. So we might end up around 5.4%, which is above the state average as well as the national average. Looking a little closer at unemployment claims, and if you look at this bar chart, which starts with January on the left to December on the right, and looking at weekly claims, you'll kind of get a good picture of the seasonality of our workforce here, and this is pretty typical year over year. Looking at our job postings over the last couple of years, they have dropped. You can see that most significantly in the chart on the bottom right-hand corner, softening the demand for workers. Many of the top posting employers are healthcare-related industry. Not a big surprise. We did do an informal poll at the end of last year, reaching out to our regional hospitals. And we learned that at that time, there were 425 positions open, and those were full-time positions that required some type of credential or degree. We do have some positive momentum and reasons to be optimistic looking at the future. We've been tracking over the last 2 years projects in the region. Right now, we're tracking 52 projects over the year that either have been announced or under construction or completed. They represent 13 of our 15 counties. The total investment is down a little bit over last year due to a large project that didn't proceed as planned, but the retained and created jobs are up overall from last year. We're looking forward with a number of strategies to better position the region in the labor market. So here's a quick peek at some of those projects that we're working on. Back in the fall of 2022, our Upper Peninsula Collaborative Development Council launched a study to better understand the regional workforce in order to more closely align the labor pool supply with the employer demand. And some of the findings that we came up with through this study and through a lot of the qualitative work that was done, we learned that a lot of our local leaders and community stakeholders were really unaware of what their local businesses really do and what the local employers' needs were. We realized that connecting local educators with local employers would give teachers and counselors more confidence in career guidance and skills development that can be directed towards local employment opportunities, especially in our high schools. The summer of 2024, we partnered with UP Michigan Works and the MySTEM Council to host externships, which consisted of 12 individual business tours, which drew in 50 high school counselors and teachers across the region. In post-evaluations, we learned that nearly all of the teachers thought the opportunity was a great value. They want to do more. They want to engage in developing curriculum that's relatable to the operations that they visited. And they also suggested more locations for this coming summer. So we're currently planning more visits for teachers and educators. In addition, we are co-hosting local job fairs, providing more opportunities for local employers to meet the local talent in both our high schools and our higher ed campuses. These events provide an opportunity to showcase the employment opportunities across the region so the talent that want to stay post-graduation know who to talk to and where to go to make that happen. Probably the largest barrier to retaining talent in the region has been affordable and adequate housing. We know that housing has been restrictive for quite some time in the region, and we have decided to invest in long-term workforce housing projects. We advocated to the legislature back in 2022 and were entrusted with $15 million to do just that. We built out a nonprofit, Build UP organization to provide gap financing for workforce long-term housing projects. So here's a quick update on some of those activities. Currently, we have 8 housing projects in the pipeline. We closed on 4 in 2024. encumbering about 8 million of the 15 allocated, with geographic coverage throughout the region. Of the closed projects, and you can see there's a little synopsis of each one. They represented everything from a 3-unit apartment complex that opened up in the city of Manistee to a larger project in the city of Crystal Falls, bringing 68 new housing units into the market. In addition, last year, we decided to start investing in our career tech education and in our ISDs and their construction programs, enabling those districts to purchase materials that are needed to spec build homes by high school students, and expanding the hands-on knowledge and skills in the region to grow our construction trades talent. In addition, we piloted a new fellowship partnership with Northern Michigan University. 2 students were selected for a fellowship opportunity to lead economic development projects, one in Marquette County and one in Schoolcraft County. The program provides tuition scholarships for 1 year. It's a paid work-based experience where the students lead an assigned project. The 2 students graduated this December, and we were really excited to hear that one of the students received a job offer from a county EDO just this week. We also have 4 students in this year's cohort. We also have some entrepreneurial fellow programs utilizing that higher ed talent and combining them with early stage startups. To date, this program has supported 17 student fellows working with 12 companies. And building off of our regional strengths of natural resource-based economy, we've been awarded the management of the Michigan Outdoor Innovation Fund. They started work in January of this year. The fund has met with 50 companies, completed 10 investments, totaling nearly $1 million, and to date have created 19 new jobs, retained 26 jobs, and recruited over $8 million in follow-up investments. And then just this week, to close out, the governor signed some bills that will result in continuing investment into our Michigan Outdoor Innovation Fund. So with that, I'll turn it back over to you, Ron.
Great, thanks, Amy. Great wrap on the 3 panelists' presentations. Really nice job, all 3 of you. There's an awful lot to unpack kind of with each one. But I guess where I'd like to start is just kind of maybe taking some of the macro that we just got to maybe more of the micro or the more immediate. Amy, I'm going to go to you first. So we hear in our surveys that labor markets have softened in terms of labor availability. And I'm curious how do you communicate the long-term message and combine it with kind of the short-term needs for employers? And what I guess I'm curious about is whether or not the softening that we've seen in labor markets is more of a temporary phenomenon, or if this is more long-term, like the labor markets we're expecting now is going to carry forward more. How do you make that message between the long-term labor shortage and some of the demographics to what employers should be doing now, especially given some of the softening of late?
I think some of the softening of late has at least brought us in the region back to some of the pre-pandemic situation. But at that time, labor was a little bit short then too. It may have been more in the manufacturing sector, in the entry-level positions, as opposed to some of the more professional positions. But looking forward and right now, I think across the board, that demand is going to remain constant. Just given our rural area and looking at, the population aging, we have a lot of ground to cover coming up over the next decade. I don't think our employers can really take their foot off the gas pedal right now. I think they need to continue to be competitive, to look at it as a competitive environment, to compete for that labor that we need. I think it's long term.
Thanks. Angeline, I'm going to go to you. Anything to add on that? And in particular, I guess I'm curious if you might have any thoughts on this labor availability issue, urban versus rural.
Yeah, Minnesota is seeing a lot of the same trends that Michigan and Wisconsin are seeing as well. So the softening is the economy is recovering from that shock post-pandemic of the silver tsunami. But really the bigger issue here is the aging population. And so we've returned to pre-pandemic levels, but as you could see from the ratio of available worker per job opening, it's still 0.6 workers per job opening. So we're still in a tight labor market. And I would expect that to be the case for the next 10 15 years until the next generation is fully in the labor force. And in terms of rural and metro areas, we're seeing more tightness in rural areas than metro, mostly because migration, like net migration is more positive in the metro counties of Minnesota, and that makes up for the labor supply that is needed.
Matt, anything else to add on that particular question?
No, I think what we're seeing in the state of Wisconsin somewhat mimics what we're seeing in Minnesota as well as in Michigan. Certainly the challenges of finding labor do vary somewhat across both the 9th district counties as well as the rest of the state of Wisconsin, but simply due to our structural changes to our age groups, we're going to see continued pressures going forward. Maybe not as tight as they were during the pandemic, but perhaps what we saw prior to the start of the pandemic.
Okay. So, Angelina, you mentioned, I think you talked a little bit more about migratory trends and things of that nature. And I'd like us to chat just briefly about immigration and how it fits kind of going forward. I think there might be some changes afoot in terms of immigration policy. And I'm wondering if you might give us some thoughts on how we should think about immigration and the state's labor force and the broader economy, kind of both for the near term and the short term.
Yeah, immigration is definitely a key component here in our labor market. We do need an inflow of labor supply. That said, like looking at historical data, even if we go back to pre-pandemic 2010s time, the number of people coming into Minnesota in normal times is in like the tens of thousands, whereas the job vacancies that we're seeing now is in the hundreds of thousands. So immigration can definitely help with the tight labor market, but we would need, but it in itself alone cannot solve the labor tightness. We would need to increase way more numbers of people coming into the state to fill the job vacancies that we have. One thing that research has found, that we found in our demographer's office, is people tend to move when they're at like key decision points in their life. So like, where do they go to college, where they get their jobs, where they buy a house. So at those points in a person's life cycle, if policy can target to attract or influence decision making to attract more people to come to Minnesota as well as the Midwest, that would help with the labor situation we're seeing.
Okay, thanks, Angelina. Matt, I'm going to go to you next on the immigration issue.
Certainly, as we saw in the numbers, the foreign-born population does comprise a notable share of Wisconsin's employees. It obviously varies by industry sector and by geography. That said, if we look at our manufacturing sector in the state of Wisconsin, as well as agriculture, especially dairy, they are dependent upon the immigrant labor force for filling a lot of those jobs. And certainly just given the demographics and the share of individuals age 55 and older in some of those industry sectors, immigration will certainly be one source of supply for filling those jobs going forward.
Thanks, Matt. Amy, on that question, I was intrigued by the slide you had on population growth. And during the pandemic, we did see some surges in more rural counties with high natural amenity. And I'm curious, are you already seeing some changes on the ground with regards to people moving in, or if you just give me some other insights on immigration in general up in the UP?
We did see an influx immediately following through, and then immediately following. It has leveled off as well. And like I had mentioned, Houghton, we've seen a lot of that influx from other countries, largely due to the Michigan Tech University. We tend to attract more from other counties and from the lower peninsula. And a lot of that draw is for kind of our natural amenity based events, locations, state parks. We get a lot of foreign tourists to Pictured Rocks National Lakeshore. And we've seen increases in traffic across the Mackinac Bridge, largely seasonal as well. So those are some of the metrics that have indicated that people want to come up here, people want to visit, and some of them do stay. We do hear kind of anecdotal stories about it from time to time. It's a little bit more difficult to track, but we do see that influx.
So Amy, let me come back to you with kind of more of an employer-focused question about, so employers have really gone through a lot of change over the last 5 years, especially as it relates to hiring and staffing. And I'm curious, I think you're out in the field talking to employers and other community leaders. I'm wondering what lessons you've taken for what kinds of things employers have really done to kind of try to stay ahead of this labor curve.
I think what we're seeing right now and what we've been seeing is, especially in manufacturing, which is where we concentrate most of our time, but we're seeing a lot of implementation of automation, brand new equipment. They're really investing a lot in ramping up on equipment and those capabilities. And so that's the primary way that they're addressing it. So hopefully, we'll see a little bit more of that leveling off and some other creative tactics.
Sure. Matthew or Angelina, do you have either of you have thoughts on that particular question?
Sure, Ron. Certainly automation has been part of it, but I think we're seeing a lot of employers in manufacturing as well as in other industry sectors just looking at how to be more accommodating in terms of hours worked, different shifts, maybe working 4 days a week instead of a full 5-day work schedule, and really looking at being an employer of choice. What ways can they do to kind of differentiate themselves from other employers in the area to make them a very desirable place to work?
Yeah, I would add that in Minnesota, I would describe it as the employers still need to work hard to attract talent and retain talent. So in addition to some of the things that Amy and Matt have mentioned, like automation and offering flexible work, our office conducts a jobs vacancy survey. And what we found consistent for many years now, and it still is the case, one thing that is more common is salary is listed. More job openings list salary to be more transparent. We see employers lowering their minimum qualifications in the job postings. So whereas in the past they may have required an advanced degree, now we're seeing more cases where work experience can substitute for for education, or they're willing to train on the job and take in candidates with who's capable of doing the work but may not have the credentials, or like kind of on paper may not have the credentials that was expected before. Yes, and then of course, offering benefits, higher wage. We saw wages jump in the years immediately after the pandemic because of all the job hopping that people were doing. And we are actually still seeing consistent wage growth. It hasn't slowed down. So offering higher pay is also another good way to attract talent.
Great, thanks, Angelina. So depending on how long our answers are to the next one, we got maybe time for one or two more. And I want to bring a question from Eric, who's listening in. And he says, we talk about jobs and unemployment in the aggregate. He's been concerned that job openings are not in sustainable wage jobs, and that we're seeing a lot of part-time growth in part-time jobs and general unemployment. And I'm wondering if you might spend some time how to think about the composition of job growth. What are we seeing, especially maybe in the lower on the lower end of the spectrum? Are the jobs that we're creating ones that are long-term sustainable for the economy? And let me start with you, Angelina.
Yeah, that is a great question. So when we, in our job vacancy survey, when we break down the job vacancies by occupation families or by industry, the most jobs are in like sales and food prep. So yes, those tend to be more seasonal, more part-time, but we're also seeing really high needs. So like the third and the fourth ranking industries with the most job vacancies are in healthcare. So like nursing home, personal care assistants, healthcare practitioners, those kinds of occupations, which are more stable. So it's a mix. With an aging population, we would expect that more needs for healthcare and nursing home and assisted living to increase. Also, the usual sales, tourism, food prep is where we're also seeing job vacancies.
Right. Amy, how about you? What are you seeing in the UP in terms of job composition, new job composition?
I think I would say the same. When we look at the job postings, healthcare is right up there at the top, and the primary number of those are, those full-time credentialed positions that remain open. But then the next one might be a retail establishment or hospitality and tourism. So those we tend to assume that those are part-time and seasonal. So it's very close, if not even in our rural area.
Okay, thanks, Amy. I think, Matt, I'm going to give you the last word on this, and then we'll move on to our next session.
Very similar trends in the state of Wisconsin. Large numbers of openings in healthcare, especially for occupations like CNAs. I think one of the things we're seeing with CNAs is kind of this push to grow opportunities for those individuals that maybe want to move beyond a CNA to go up the career ladder in some other healthcare field. Or really support those individuals who are CNAs who want to stay in that profession because they are very highly needed and very important to our economy. That said, we are also seeing a lot of job openings in hospitality industries, especially in a lot of our kind of more tourism dependent counties in the 9th district. And I think one of the other challenges that I've heard, especially for individuals who may have moved to some of our high natural amenity counties, is that there's not necessarily the jobs available in some of the professional technical occupations that they may have expected. So they may be either looking for remote work or looking to maybe move to another area that offers maybe a thicker labor market for those types of occupations. So there is a bit of a schism in terms of the types of job openings that may be available in a lot of our 9th district counties.
Right. Thank you, Matt. And thank you to our three panelists. Really great discussion. Appreciate the time and investment, not only today, but just for prepping with this. Great job, everyone. For those listening, there have been a number of comments in the Q&A, and I'm going to, in particular, for a couple that were directed at a couple of our panelists, I will try to forward those questions to our panelists, and maybe we can have a discussion offline on some of these questions as well. So with that, let's first, again, thank our three panelists for a great job and for all the work that goes into these presentations. I'm going to turn it over now to my colleague, Eric Garcia Luna, who will lead our final session. Eric, floor is yours.
Thank you, Ron. Thank you. Thank you to all the panelists as well for a great conversation. That was very insightful to hear. My name is Eric Garcia Luna, Regional Outreach Director with the Minneapolis Fed, and I would like to welcome all of you to the last, but definitely not the least, panel discussion of the day. We just heard the takes from experts on labor dynamics, and it is my honor to be joined today by an amazing group of professionals from the western part of our district, who will now take the conversation to focus a little more broadly on economic conditions. The economy of the last few years, you've heard this a couple of times today, has been overall resilient, and our panelists today, whom I will say that besides being top-notch experts, they are already good friends of the Minneapolis Fed, will walk us through how that's being reflected in their individual states. Very similar to how the last panel went. Each panelist will have about 15 minutes for their individual presentations. And like in the last panel, we're going to conclude with a Q&A session for the remainder of the time. Please do continue to submit your questions to the Q&A box. We'll try to get to some of those during the Q&A session. And now, to keep things moving along, I would like to introduce the first of our three panelists. We are joined today by Joe Santos, who will be covering the South Dakota economy. Joe is a professor and director at the Ness School of Management and Economics from South Dakota State University. Welcome, Joe, again, for joining us, and thank you for joining us, and the floor is yours.
Thank you, Eric. Just a quick technology check. Can you see my slide deck, and can you hear me?
All is working well.
Okay, great. So thank you for this opportunity, and thanks everyone who's tuning in here to listen. I'll dive right in. So state economic conditions for South Dakota. I'm going to take this in a few directions. I'm going to start with the production side of the economy, just to give everyone a sense of sort of what we do in the state in terms of economic activity. And so you'll see here, as you look quickly across these pie wedges, fire, finance, insurance, and real estate, a very big piece of what happens in the state of South Dakota. Agriculture, of course, and construction and manufacturing, and then some downstream effects like wholesale and retail. But what I want you to take away from this as we go forward now and start to think about economic conditions within the state is, again, the importance of, let's just think of it as finance, agriculture, and then construction and manufacturing. And I'll come back to those industries as we go through the deck. So a little bit about prices, because I think that has a lot to do with how those industries have performed in the last few years. And I'm thinking here about a macroeconomic phenomenon we're all very aware of, and that's inflation, of course. But I want to bring this down to the regional level and think about how these price effects have sort of shaped economic activity within the state. So what you're looking at here is really, really straightforward. Just think sort of state GDP, if you will, the blue line. And then economic activity, just quantity of production. So a real simple way to think of it is blue is being driven by both prices of goods and services and the production of goods and services, whereas red is being driven only by the production of goods and services. And so the big wedge here that you can't help but notice between the two, that's the effect of inflation over time within the state in particular. And I want to exploit that feature in particular. That is that we're looking at state level data, state level prices times quantity, and state level quantity, think blue and red. And we can bring these two data sets together to create an interesting index, which is a price index. So here we are. You see over time, the blue bars, that's prices times quantity, and then the red, just quantity. quarter after quarter after quarter. And what you see happens, of course, is we have this inflationary effect within the state, so that blue rises very high above red. And for a time, there's sort of this gap. That is, the economic activity in the state is really driven largely by the valuation of that economic activity. It's just all price effects. But the actual activity in red is not very impressive. And then we see a bit of a change as we look more toward the current period, where we see a bit more red here and then a bit less red. And I'll focus on that in just a second. So if we remove the blue lines, we see the actual economic activity in the state. And so since COVID, more recently in 2022 and 2023, we've seen this sort of burst of economic activity. Think those red lines go up. And then, of course, we've noticed those red lines coming down. So I want to just focus on that a bit more as well. So back to these lines then. If I have the blue line, think prices and quantities, and I have the red line, think just quantities, I could bring them together and I get a price index, a price level. And I think this is really important. So you've heard a lot about this in the context of the macroeconomy and inflation. Well, now you're hearing about it within the context of the regional economy of South Dakota. And what you're looking at here is an average price level, but I want you to think about it in terms that you've been thinking about it in terms of the US economy. You know, the price of eggs that we all keep talking about. You can think of this as sort of an average price level, or the price of eggs before the pandemic, and an average price level, or the price of eggs after the pandemic, as recently as last quarter. And so prices have risen in the state much as they have throughout the nation. What's interesting here is, though, you can compare this state level measure of prices to the national level of prices. And, whoops, sorry. That. And what you see is purples above green. So how do you think about that? We've actually experienced more inflationary pressure within the state than we have in the nation more generally. And again, I'm going to come back to how this has affected those principal industries: finance, agriculture, construction, and manufacturing. And of course, if we take a growth rate in these data and we go from price levels to inflation, again, we see this theme that for the state of South Dakota, we've had inflation, much as the nation had, but if you will, regionally speaking, we've had more of it. Purple has been above green for much of that time. Since then, we've experienced this disinflation, or a fall in the inflation rate, much as the nation has. But throughout this inflationary episode, we've experienced a bit more of it relative to the national economy. And again, I think that's going to matter in explaining some of the effects on finance, agriculture, construction, and manufacturing. So I want to look at just how this has affected people in terms of personal income. And again, I want to compare it to the national economy for some context. So the blue line here is South Dakota's personal income, and the red line is the United States personal income. And you'll notice some deviations between blue and red, but I want to focus on the most current situation. And so this is the third quarter of 2024. Whoops. And what you notice there is these lines have converged. And so we're looking at two numbers, you know, go up, turn left, and they're in the 70-ish thousands range for the state and for the economy, the US economy more generally. And I want to decompose that a little bit. So again, the far right, we're looking at personal income for the state and personal income for the national economy. So let's look at it as a table. So there it is. In that far right that you were just looking at, when you went up and turned left and looked at the y-axis, you would have seen a number like 73.7 for the state of South Dakota and a number like 73,426 for the nation. All right, what I want to do is break this down a bit. I want to fill this space inside this table. I want to think about personal income as really being driven by three forces: essentially productivity of labor within the state and the nation, the employment rate, and the labor force participation rate. And by doing so, see if we could figure out what's really driving and what is likely to continue driving personal income in the state as we go forward. So here we go. What I'm referring to is the fact that that personal income I just showed you is really 3 bits multiplied together. Again, something like labor productivity, something we would think of as an employment rate, think 1 minus the unemployment rate, and then this labor force participation rate we've been hearing so much about from the fantastic panel that preceded this one. So what I want to show you is that in the state of South Dakota, the primary drivers of the personal income level, think the left side of the equal sign, has been the employment rate and the labor force participation rate. Less so this income per employee, or what I'm thinking about as productivity. So I'll show you the numbers. But first, some of the data. So here's the employment rate. So for the state of South Dakota, you're looking way up here and you're getting a number like, I don't know, 98%. So how do you use that in a sentence? There's only a 2% unemployment rate in the state. When you do the same thing for the national economy, you're getting something like a 90, I don't know, 4-ish%. And that leaves something, or sorry, 95 leaves something like a 4 or 5% unemployment rate. So we have a very high employment rate in the state. And again, when you look at the gap between 100% and the blue line, there isn't much farther to go. But it's a major driver of personal income in the state. And then that labor force participation rate, same thing here. When you compare it to the national economy, you notice, it may be dropping a bit. And we've talked about this in the other panel, and demography and those forces being what they are. But nevertheless, the rate is very high. And there's no simple way to lift our labor force participation rate. So very high relative to the national rate as well. So two primary drivers of personal income in the state right now, the employment rate and the labor force participation rate. And the rub, if you will, is that both of those rates are rather high, and there's really no simple way to make them go much higher. So let me show you that in the data. I promised I would fill out the table, so here I go. There are the data. So for South Dakota, how do we get 73.7? Again, 3 bits, and I'm going to focus on the 2 bits I just showed you in graphical form. An employment rate of 98%, great. That's a primary driver, but 98 is really close to 100, so you can't get that much higher. And a labor force participation rate of 68, again, great driver, but demography being what it is, there's not much we can do to make 68 go to 78 or 88. So, which leaves this productivity measure. And it's a smaller number than the United States measure overall. So how do you use all of this in a sentence? We are keeping up with and in fact exceeding national level personal income through a very high employment rate and a very high labor force participation rate, not from a very high, let's call it a labor productivity rate. And again, that's a very sort of general way of thinking about income per employee, but that's not the primary source. And it necessarily must be going forward, because 98 is about as close as you can get to 100, and 68 is about as close as you can get to our labor force participation rate ceiling. So it's going to have to come from income per, essentially per employee going forward. And so that's a larger question maybe for Q&A, but that's going to have to be the driving force rather than the other two. Okay, so I promised I'd come back to quantity, right? I had these red bars. Remember, I stripped them of the blue, the price times quantity. I said, let's just look at quantity. And when we did, we noticed we had some economic activity there recently, but then very, very recently, we see something very different, right? So I just want to focus in on that to get a sense of where the economy is now with respect to economic activity. And so the way I want to do this is sort of a time frame transition. So I want everybody to just focus on the region we're all talking about, right? Something like that. Focus up there and notice the colors. And so if you're green, if you're dark green, it means that your economic activity, the growth in quantity in economic activity is very high. Then as you get to a pale yellow, you're going the other way in terms of your economic activity growth. So you'll notice this is 2023 Q1. And so what I'm going to do is just go transition the slide here. We're going to go to Q2 and Q3 and Q4, and we're going to watch the transition of the 9th District's economic activity through time, right? So here it is, Q1. Now, again, you're looking up at South Dakota. I hope that's all you're looking at, right? But also North Dakota and Montana, of course, and so on. Now watch the color transitions. We're going into 2023. Things are getting very good. Q2, Q3, Q4, right? Dark greens are good. And then first quarter, 24, second quarter, 24, third quarter, 24. And so you're noticing the sort of bleaching out of, if you will, of economic activity in those states. So the point of this is right now, if you're looking at real time, you're looking at quarterly growth in economic activity. We have much slower growth. In fact, as I'll transition in a moment and show you the number for that third quarter of 2024 that corresponds to that very pale South Dakota image is negative. So it's a reduction compared to a year ago. So let me show you that now. That last data point that is defining the color of that image of the United States for South Dakota is this data point down here, right? So that's overall growth in real GDP for the state. It is negative, a little less than 1% in that last quarter compared to a year before. So what have I done here in the figure? I'm also now showing you the sectors of the economy, and just a few, of course, that contribute to the overall number. So you've got retail and healthcare and manufacturing and construction. So the point is, if you went through and picked up all of these industries, ultimately all of these bars would add up to this red one. Now, as you're listening to this, you're saying, Joe, how's this going to work? You've got a bunch of blue bars. They're all positive, but yet overall you get a red bar. That's negative. There's got to be some red bar specific to an industry lurking somewhere down below. And in fact, there is, and it's quite profound. It's agriculture. So we have a dramatic drop in a primary industry. Remember, I said we're big on finance, agriculture, construction, and manufacturing. Well, agriculture has this about 4% drop in economic activity in that third quarter compared to a year before. That's what's explaining the overall drop largely in the state economic activity. So again, it doesn't mean this is going to persist. It's just this quarter, Q3 2024 compared to the prior year. But that's where we are right now, an economy that is slowed. And the major contributor, just arithmetically, of that slowdown is the agricultural industry. And just, we've talked about this and Neel talked about it during the fireside chat, but this is just proprietor farm income for South Dakota. And this is where we are now. A year ago would be one to write about there. That's about a 40% drop in proprietor income, farm income. So again, just another way to think about that driver of economic activity more generally, given that this is a primary industry in the state. We could see it in the farm income data as well. And again, the issue has to do with crop prices and that regional inflation I'm going to come back to now in just a minute, and what it's done to input prices for agriculture. Okay, a little bit about people. So population growth in the state has been high. It continues to be, again, relative to the United States. And so you can just, go up, turn left, as I like to say, and look at the y-axis and get a sense of where we are. But population growth in the state's been large relative to the country. And so I want to, again, decompose that a little bit and see what's going on there. And other guests and other panels have done this as well with natural growth versus migration and so forth. So if we pick that apart a little bit, here's a table I'm showing you. What I want you to do is take a look at that population change of 37,940. And what I'm doing here first, just so we're all looking at the same thing, just look at these blue numbers. So these two numbers, without some residual error correction and so on, add up to that blue number, right? So how do you use the table in a sentence? Over a relatively long period, we see 37,000, new people. The natural change, about 9,000, the net migration, about 28. So one way to summarize that is over that entire period, say since the pandemic, the growth in the population was being driven largely by the growth in net migration, right? 74% relative to 25. And again, there's some unknown residual there that's explaining the 1% that you're all seeing that's missing to get to 100. If we take a look at the net migration now, think of it as these two numbers add up to that number. What we also saw over that very long time span, relatively long time span of 4 or 5 years, is that much of that was domestic. So essentially folks in the United States net migrating to South Dakota versus international migration, net migration into South Dakota. But that's over that period that starts with the pandemic and leads up to now. If instead what we do is take a look at just the most recent year, we see the pattern has sort of, I'd say, normalized a bit. So new numbers now, only a year, so it's a smaller number, but these two numbers still add up to that smaller number and so on. Same approach. But now what we notice is it's not as much net migration as it is natural change. So if you recall, the 41 and 59 was more like 25 and 75 before. So more of it from natural change, less of it from net migration. And again, that's only the most recent year. And then same transition here. Likewise, if we want to know more about the net migration, these two numbers add up to that number. What we notice is, again, a transition, and that is to say, now the source is, relatively speaking, more coming from international net migration as opposed to someone in Nevada moving to South Dakota, which would be the domestic net migration, right? So bit of a change. If we look at the overall pandemic, we see a lot of the population change coming from net migration, and we see a lot of that coming from domestic sources. If we just look at the last year, we notice a bit of a normalization now. Now, net migration is not as responsible for population growth as it was since the pandemic more generally. And when it is responsible for population growth, it's a lot more from international sources than domestic sources. So a bit of a transition, and I suspect, again, more of a normalization in that sense. And then a bit about jobs. So these labor markets are very tight in South Dakota, much as they are everywhere else. But some of these industries, again, remember our big ones: finance, agriculture, manufacturing, and construction. Some of these industries are experiencing employment growth. The unemployment rate's very low, so there's not much to say there. But where's the employment growth? Some of these industries experiencing more of this than others. So taking a look at finally jobs, what I want to do here is show you a picture that's going to be a mess in just a second. And so first, just to give you an example of what you're going to look at, these are government jobs. These aren't the actual number of jobs. You can't tell that from looking at this. But this is saying there's some number of jobs right before the pandemic hits. And we're going to normalize according to that. So one just means you have the same number of jobs as you do the moment before the pandemic hits. And this number here, I don't know, 1.05 or something, says you've got about 5% more jobs than when the pandemic hit, right? So to give us a sense of job growth in the state. Okay, so let's now put all the industries up there, or the ones I want to focus on. You get this big mess, and I want to argue there's actually something going on in this mess, so I'm going to focus on little bits of it at a time real quickly. So where do we see the employment growth? Primarily construction. Remember, that was one of our pie wedges I focused on, construction. And professional and business services, red, and then a little bit of growth, again, government, right? That's where we see the lines are above where they would have been just prior to the pandemic. Manufacturing is sort of an interesting story with supply chains and all of the sort of increase for durable goods. We saw the jump in manufacturing employment in the state, but that now has come back down a bit, and now there are fewer jobs in manufacturing than there were before the pandemic. So it's sort of a hump shape. And then something that's sort of interesting here in terms of red, information is below where it was, but it's a very small sector in the state. But finance, remember, is that big wedge I started the discussion with. And there we see a fewer number of jobs in technically finance, insurance, and real estate, all of those sectors combined, than before the pandemic. And sort of an open question of what exactly is going on here. We suspect it has something to do with automation. A wonderful institute in the state called the Dakota Institute has suggested perhaps it's also having something to do with the merging of financial institutions and consolidation and so on. But nevertheless, one of the largest sector in the state by state GDP is actually experiencing a contraction in employment. So thank you for your time, and I look forward to Q&A opportunities.
Thank you, Joe. That was great. We appreciate your insights as always. Our second speaker, who will talk about the economic activity in North Dakota this time, is David Flynn. David is a professor of economics and finance at the University of North Dakota. Welcome, David, and thank you for being here again.
Right. Thanks very much for the opportunity. Happy to be back here again and talk about the economic activity within North Dakota. I took a slightly different tack this year than in years past, and we'll see that in just a minute. North Dakota, in many ways, persists. There's not necessarily new stories. There's not necessarily stories of development beyond where we've been the last 5 to 10 years, but those have been good places to be. So at some level, it's not a surprise. The strength of that energy economy is still there. In particular, the fiscal implications from that energy economy still go on to the great benefit of the state. There have been some population adjustments and changes over this time frame, the last 2 to 3 years. We've seen some adjustments in terms of population outflows. Domestic migration hasn't necessarily been the strength that it was, say, in the 2010, 2016 timeframe. But there are some key factors to look at still. Labor market, we've heard a lot about. It's challenging at times, but it's also not a new challenge. And as conditions become better in the United States overall, while it presents some problems, it's also not necessarily a situation North Dakota's not used to dealing with. It seems the state's in a perpetual shortage of labor type of environment and situation. The strong energy position for the economy right now, with the potential change in the national policy focus with the new administration coming in, this could be a potential boost as well. The good to great fiscal position of the state right now is obviously a benefit as we go forward with some uncertain economic times. And then some of the migration numbers may be indicative of some sub-state strength and changes in the economy as well. And as usual, so many of these things are correlated and have causal relationships and feedback loops that it would take too long to go through. It's an odd year, and I don't mean that in like a weird year sense, but that means it's the North Dakota biennial legislative session. So the legislature is in meetings right now. It's always a lot of activity and interest going on in that time frame. Add in a new presidential administration coming in and the legislative session meeting. There's a lot of questions about national outlook, national policy focus, as well as then what does that mean for the state and how are we going to proceed? The great thing about this is that in many ways, for people like me who try to do the forecasting and outlook for the state, we know where the focus is right now, and we get it set for the next 2 years in some ways. So with that as a backdrop, I'm going to look at the state the state of the state at a different kind of level rather than aggregate state numbers. I'm going to look at the state based on the rurality characteristics of the state, or the metro versus non-metro characteristics within the state. Some things to highlight before I get into the charts and the pictures. There's a persistence of output gains from the non-metro areas. When we look at the real GDP numbers, we'll see this. There's a consistency of the labor market situation across this rural-urban continuum as well. And then there is a turnaround in the net domestic migration in the oil region. Domestic migration has been variable and fluctuating for the state. We've seen gains from states, Alabama and others. We've seen losses, though, and reversals of these flows going on as well, such that domestic migration at a net level isn't a driver like it was earlier. However, international migration has been fairly strong. The net international migration has been a strong force for North Dakota, obviously filling some of those labor gaps, which does mean that policymakers and others are focusing on what's the national discussion around migration going to be and what does it look like. So just so we're clear, this is from the U.S. Department of Agriculture. This is the rural-urban continuum codes. These were just revised in 2023, made public, I think, in 2024. The darker the color is the more metro the area is. The lighter the color as we move to that yellow is the more rural. For whatever reason, they abandoned the term rural and are now using the term non-metro. Fine with me. We just move on. What I do think this highlights at some level is the the geographic divide that goes on in the state from some of these characteristics, as well as then the economic divide. As an example, this left part of the state, the western, is where we conventionally get the oil patch. The Bakken oil field and the oil activity is in this area, and we can see, you know, two sort of pockets, if you will, of a non-metro urban population located there. This middle portion, this is the upper part here. The purple is the Minot area. This is the Bismarck area below it, and then we get Fargo in the east, and we get Grand Forks, where I'm located, out there as well. And so, but you can also see a lot of yellow, sorry, I don't know what happened there, a lot of yellow showing up in this as well. So there's a lot of rural areas there. And so just for completeness, you can see I only have 6 categories up there. There is a category 1, category 2, category 4. North Dakota counties do not, none of them fit into those categories, so they just don't show up. So I just excluded them. Just some quick examples. The metro counties are things like Burley, which is Bismarck, Cass, Fargo, Grand Forks, Ward counties. The non-metro, but the category 5 is the Stark and Williams. That's the oil patch. That's Dickinson and Williston. Non-metro, we've got Richland, Barnes. We've got non-metro with 5 to 20, but not adjacent. These are the big categories. I just throw that up there for examples of what these counties are for individuals. And they, as you can see from the map, they're all over the place. There's a real scattering there. But as we look at this, this is real GDP. And I just picked 3 years, 2003, 2013, 2023. That level 3, these are the metro area, their share of the state real GDP went from about 69% down to about 49% in that 10-year time frame, and has really stayed there over time. Who was gaining at the expense? Well, you can see it's this category 5. That's the oil patch activity right there. And so it's really indicative of that shift in the state economy out of the activities you would find in the metro areas. These are retail, these are information, manufacturing, those kinds of activities, and that shift into energy production that went on. And so that was a significant change. That change persisted. You can see from 2013 to 2023. Not a surprise. This 2013 is immediately preceding the oil bust in western North Dakota. So this was essentially peak oil activity or nearly peak oil activity in western North Dakota. So there's been a little bit of a pullback from that, but not much. But other areas have gained as a result of that. But again, other of the more rural areas have gained oil field activities, other kinds of innovation activities. And so it hasn't been the case that the metro areas, you know, surged back. The same situation actually seems to occur when we look at the unemployment rate across this continuum. So the same you know, divide here, just looking at about the last 10 years or so for the unemployment rate, we see the COVID situation, and notice Williston and that oil activity saw the largest uptick in the unemployment rate as a result. Now, this was a combination of things, but certainly the concerns about oil activity, the concerns about people not driving to work, less demand for fossil fuels as a result of that. There was a really rapid and large layoff situation in western North Dakota, but very reasonably quick. All of the states go back to a roughly similar, all the counties go back to a roughly similar experience, staying somewhere between the 2 to 4% range for the most part, all right, with some variability and fluctuation going on in there as well. I mentioned migration, and so again, breaking it out by rural area type, the 2022 to 2023, we see most of these areas staying roughly the same, minor changes in where they're at, but the oil patch went from a net negative for the North Dakota population change to a net positive from minus 1,500 to plus 700. indicative of perhaps some changes going on in the oil patch, a increase, a driver of that. North Dakota, however, I will mention too, in terms of internal dynamics, we are apparently one of the few areas in the 9th district. We still have births in excess of deaths, thanking a lot of the oil activity from the 2005 to 2015 timeframe. We brought in lots of population from outside the area. A lot stayed. These were mostly males, aged 20 to about 30. A lot of them unattached males started to engage in the family formation type activities and stayed here afterwards. And as a result of that, you're still seeing an echo of that Bakken with the the Bakken baby boom, boomlet occurring there as well. Okay, so I mentioned the western part and the energy economy, and so the energy outlook. Obviously, the recent election has been leading to speculation about a very good outlook for oil and the oil economy. Lots of suggestions of drill, drill, drill. It's a little bit difficult when you're talking about fracking type activity. Obviously, there's a lot of drilling, but it's not the same level of investment in terms of we can pull back quickly, we can adjust quickly. There's a little more commitment that occurs. So labor markets and current market price actually for North Dakota oil, these may actually limit the additional upside we might see. There could be spillover effects, always my favorite joke when talking about oil, to other industries and areas that, again, that could be there, but there's potential limitations here. You can see the recent North Dakota first purchase price for a barrel of oil currently stands in roughly the $60 to $80 range. This is near recent peaks and reasonably close to some of the persistent highs. You can see the last boom in the 2010 to 2014 range. We saw 80 to 100, so we're not that far off of where we were before, which is why I say there might be some limitations to really what the upside can be, the further upside can be, because of course that initial boom, we went from $40 to $60 range, right in here around $50 in 07. We went over $120. So I mean there was significant upticks possible then. Now in this graph, I chart the momentum. I look at the price, current monthly price compared to the average of the last 24 months. And then I look at the production in this chart and compare it, the monthly production, to the last 24 months. With fracking, they need to see a persistence of price levels at a certain rate so that they know that there's an opportunity to sink more wells, pull the oil out, and have it be available. The same kind of thing occurs when you look at the forward 6 months for production. The higher this number above 1, meaning the higher it is above the last, the price is above the last 24 months, the more likely they are to increase production. And so what we see is that there is some momentum going on. The prices have been higher. They've come back down recently of late, but this is not a surprise. We've been doing some sideways movements under the Biden administration. There's a lot of hopefulness about price rises coming forward. And so we've seen some sideways movement in production. But again, the rumblings are that there will be some movement positive for the industry going forward. We saw high interest rates in response to the inflation. We don't see a lot of structural concerns in the finance sector in the state. We are seeing some increases in the non-performing and the non-accrual status loans in the state, but it's not to a level where there'd be any kind of serious concerns about solvency of institutions. Housing prices are still increasing. That increase is moderated, but it's still positive, and that's the outlook. We're expecting about a 4 to 5% increase when all is said and done with the data for 2024. That was 5% in 2023. It was 10% in 2022. And so again, still some expectation of some offset. But we'll have to wait and see again. The Fed policy obviously is a driver for some of this activity. Like I said, the outlook is for further declines in that price growth, but it's still supposed to remain positive, compared to where listings are right now. Capital-intensive industries, we've seen some consolidation, construction equipment going on in the last few years, but several are also thinking of expansion now that the prices have come down and interest rates are starting to reduce as well. The fiscal outlook. North Dakota's fiscal picture is quite strong. Total tax collections are on track with other recent biennia. We'll see that in the next slide. We had some recent peaks and highs. Property taxes is a big topic in the state of North Dakota as well. We had a referendum to the Constitution in the last election that would have banned property tax, and it failed. And it failed somewhat spectacularly. Every county in the state, if you look at the data, voted against the referendum. And so now it has become a topic for the existing legislative session. There are a lot of proposals out there about how we're going to deal with these things, reducing property taxes, swapping funds from other places. A lot of this will get into legal hurdles, in terms of whether this is allowed. Most of these proposals seem to be foregoing what I think are simple solutions from other places, and it depends on whether or not your concern is the overall level of taxation, the volatility that occurs because of valuation changes. I think actual, investigation into what's the biggest concern for people, because traditionally it's been, I can't predict where my taxes are going to be. That seems to be something more of a let's cap increases in valuation. You can see the tax changes are there. The yellow is the latest biennium, and it's pretty much on track with what we've seen in most of the recent biennia. And residential, from 2015 to 22, there were about slightly more than $10 billion in property taxes were collected across the state of North Dakota. A little more than 35% of that was coming from residential property taxes, which is why I think it was something of a surprise that the referendum failed, or certainly failed as spectacularly as it did. The strengths and risks, to sort of, I can't conclude, there's too much, so we're just going to sum up. Energy outlook is still strong, but there are risks. Labor and labor responses will be important. Policy inconsistencies and delays, I think, are another issue. Just saying that we're going to do something and actually implementing it at the policy level are going to be two different things. Always the concern about international events. And I think there's some concern that is this stunting diversification? Are we foregoing wind energy? With such a preoccupation at the national level, driving local concerns on fossil fuels, are we looking at renewables to an inadequate level? Is it also reducing innovation in those areas? Labor market, I think North Dakota has seen a reduction in the stress on the labor market. I think we're closer to what I would call an equilibrium, but it's an inferior equilibrium. North Dakota is sort of perpetually short of labor, but I think the recent international migration has been a huge success in terms of bringing people in and filling these. If that changes, labor pressures could certainly return and would be problematic. And so many expressed policies for this new administration coming in align with certain North Dakota economic sectors. Here's the biggest concern I see with it right now, and that is it's automatically a shorter lifespan. This is a 4-year term, and so we don't have the possibility of, we don't have the guarantee of 4 years plus another possible 4 years with the same particular administration as this would be composed. And what does that really mean in terms of the opportunity to capitalize and invest? Does it make people short-term focused? As your keynote speaker said today, a lot of renewables and a lot of energy sector folks, they don't operate in 4-year increments. They need to operate in 8 and 12-year increments. And so a potential reversal in 4 years will probably not convince them to jump in and take advantage of these things. So thanks very much.
Thank you, David. Much appreciated. Before I introduce our third panelist today, I know that we're getting close to the noon hour here, and I just want to make sure that, if anybody has to sign off, please do so at that time. But I hope that you can stick around for a little longer. And we may not get to as many questions or any questions if we get to noon and we haven't heard everything that we need to hear from our next panelist, who is Amy Watson, and she will be covering the westernmost part of our district, the state of Montana. Amy is the state economist at the Montana Department of Labor and Industry. Welcome, Amy, and take it away.
Thank you. Let's see if I can, do you all see okay my screen? That work?
It all works out. Yep.
Okay, great. Yeah, so my name's Amy Watson. I am the state economist with the Department of Labor and Industry. And I'm going to give a brief economic update for what's going on in Montana, hopefully, and we can squeeze in a couple questions here at the end. So in general, I'll echo a lot of what's going on in the Dakotas as well. We've seen pretty strong continued labor market growth. I'll touch on it's led a lot by higher than the normal in-migration, strong labor force, and strong employment growth. Our unemployment rate has ticked up a little bit over the last year, but still well below what we would consider more of a normal rate of unemployment. And we still do have tight labor markets in Montana. Despite those tight labor markets, we've still seen pretty strong economic growth. In the last year or two, we've seen economic growth about 4%, which is above the US rate and remains elevated compared to our pre-pandemic levels. Business formation has been a really strong driver of a lot of that growth. We've seen record high business formations continue in 2023 and then continue into 2024. And that's translated to increases in income for our households in the state, particularly through wage growth and through proprietor income growth. Of course, as we look forward, we're still concerned at the statewide level about national inflation. We've seen it come down, but it is still impacting the state, particularly through our housing market. And then we've seen again, some alleviation of those tight labor markets over the last year, but we still see more job openings than we have unemployed people. So that's still a concern moving forward. Overall, we've seen our total population growth continue, our labor force continue, and our employment growth continue and reach record highs as we continue into 2025. We expect that that will continue as well. Actually, in 2024, was the first year since the pandemic where we had a natural increase in our population. I believe the increase was like 12 people. So just barely above zero, but we did for the first time in 3 years since before the pandemic see that contribute to our population growth. As I'll talk about in just a moment, we have seen the majority, all of our migration or all of our population growth come from migration, particularly domestic migration. And that's translated to us, the state being able to maintain significant employment growth, particularly exiting the pandemic. You can see Montana here compared to the US. We didn't have quite the drop in employment that the rest of the nation did during the year 2020, but we've seen that our employment surpass pre-pandemic levels nearly across every industry in the state. And we project that our employment growth will remain right around 1% over the next 10 years or so. When we look at the industry breakout, initially exiting the pandemic, we got a lot of that employment growth from our leisure activities, which is things like hospitality, accommodations, and the tourism industry in general. We've seen that really take off. Montana is a great place to live and work and to visit and to enjoy our scenic environment. And so we saw that happen a lot, particularly in 21 and 22. Some of that employment growth has slowed down a little bit. Since then, over the last couple of years, it's slowed down slightly. We've seen pickups in growth in healthcare. In particular, in 2023, we saw that was that particular industry grew by about 3.1%, and we project the highest number of job openings in healthcare compared to any other industry in Montana. So that again relates back to what many states have said as we've been talking this morning, is that our aging population, the increase in retirements has an effect on the labor market, but then also from the demand for healthcare services, we anticipate that will grow and lead to the need for more healthcare workers. We still see pretty tight labor markets in the state. Back in the Great Recession, we had about 3 unemployed workers for every 1 job opening. That dynamic flipped really around 2014, 2015, where we saw tight labor markets of about 1.4 job openings per person. Of course, drastically, but albeit temporarily, we saw that dynamic flip in 2020. And then as a part of our very rapid growth exiting the pandemic, we saw a significant increase in the number of job openings and a very low number of unemployed persons. So at the height, sort of that tight labor market really hit a peak sometime in 2021, 2022, and then over the last year or two, we've seen those lines sort of converge. So now we're back to we still have tight labor markets, but it's more what it looked like before the pandemic, which was tight, but we're looking at somewhere about 1.8 job openings per person. So nearly 2, still certainly tight labor market territory. Excuse me. Some of that tight labor market came from, again, that really strong recovery coming out of the pandemic. And just the number of job openings. On the demand side, we needed a lot more workers. But on the supply side, we've also seen our aging population and declines in our overall labor force participation rate. Particularly during the pandemic, albeit this has been a concern consistently, but it was exacerbated during the pandemic, was the impact that parental labor force participation also had on our workforce. And so we saw some impacts of reduced childcare availability and affordability impacting parental labor force participation. In general, we've seen our labor force participation rate decline, as many other states have, over the long run. Over the last few decades, it really has been declining, again, because of that aging population. And right now, we have a labor force participation rate overall of about 63%. Which has been fairly stable really since the pandemic. We haven't seen it drop any more than we were already expecting it to because of the pandemic. So we've stayed kind of on trend, although this trend is negative. And again, that's because of the increase in retirees in the state. Right now, we have about 330,000 Montanans who aren't working. And the majority of those folks are over the age of 55 and are retired. So you can see that this chart breaks it out, those out of the labor force by age and by primary reason. So those light blue bars are the retirees. They're primarily concentrated in that 55 and over category. But we also have seen this caring for family impact a lot of our prime working age individuals, again, getting back to those childcare availability and affordability issues, and then school enrollment among our younger aged Montanans are the reasons why they're not in school. But when we look at it across age category, labor force participation rates have held fairly consistent, particularly over the last 5 years or so within the age category. So it's not that our prime working age or our young adults are less likely to be working than they were 20 years ago, but more the decline in the labor force participation rate is the population shifting from those high participation rate categories into that, particularly the 65 and up category, which only has about 21% participation. Another way to show this really, really quickly is looking at by the reasons that people aren't working. And by far and away, most of that is retirements. We have over 210,000 retirees in the state, and that number has been increasing consistently. This dates back to about 30 years ago. So when we look at what we've been doing at the Department of Labor to address some of these tight labor markets, we can look, of course, at the supply side or the demand side. From the demand side, we talk about things like AI and other labor-saving technological advancements that might reduce the need for workers in the state. We also focus on increased productivity, particularly at the Department of Labor, through access to training programs and making sure that individuals are well matched in the jobs that they are employed in. From the supply side, we talk about ways to increase labor force participation. As I believe Joe mentioned earlier, that is a really difficult thing to do at the statewide level to see any increase in labor force participation. So what by far and away has helped us address the tight labor markets over the last year has been our rapid in-migration. Montana's long been an immigration state. We do tend to see more people come into the state than leave each year, but this has been particularly true post-pandemic. So through the last 4 years or so, our population has grown nearly 5% over that time frame due to in-migration. And you can see this is a map, of course, of the state and our 56 counties and where that migration has been the strongest, and that's in the western portion of the state. That does tend to be the more tourism heavy, the more scenic areas of Montana. And that's where we've seen more of the growth. We have also, that does translate to increases in our labor force in those areas. We've seen labor force participation rates of immigrants be higher than our existing population. So that leads us to conclude that they are contributing to the labor force. They tend to be a little bit younger than our population is, than the existing population, and a little bit more likely to participate in the labor force. So we see that as a positive for the state from a labor availability standpoint. One benefit of our tight labor markets has been really rapid wage growth. We're one of only 2 states that has seen positive real wage growth since the pandemic. This shows through 2023 and 2024. So far, we estimate our average wage to have grown another $1,000 or so. We're about $58,000. And a lot of that wage growth has been concentrated in some of our professional and administrative services industries. So you'll see, as well as some leisure activities. So this shows by industry for wages, what the average annual real wage growth has been post-pandemic, and then the current annual wage. So some of our wage growth has been in our lower wage industries like leisure activities and in our admin and waste. But overall, things like our professional services industry has really driven a lot of our growth as well. Of course, Montana is also a very entrepreneurial state. We have a lot of business formation, and we've seen a record high formation for businesses over the last year or two. And that's translated to income growth as well. So right now, Montana, this shows you the per capita income and then the per capita income growth over the last 15 years or so. So we've seen it slow some, but not tremendously. When we look at GDP growth, we've also seen very, very strong GDP growth really post-pandemic. So in 2020, the economy did shrink slightly, though not as significantly as it did across the rest of the nation. And then in 21, 22, 23, we've seen above average growth, not only above the US average, but above what we would expect for Montana. And that's been driven a lot by growth in professional services and some of our tourism and leisure activities industries. You can see this is that breakout by industry. We've seen a lot in our business services, which would be some of our professional services and leisure activities. We've seen not as much growth in our natural resources, agriculture and mining. We had a similar story more recently with GDP and agriculture being a drag on our gross domestic product. But overall, we have seen continued growth, and continued growth is projected, driven a lot by our more business services and service-heavy areas of our economy. So with that, I'll wrap up. Really, we do continue to see and continue to expect more rapid economic growth. We have seen some headwinds coming our way through tight labor markets, and so our focus is on productivity enhancements. And we also look for continued population growth, primarily through in-migration, but hopefully those natural changes will help us as well. I've put a link to our publications tab here. The QR code will lead you all to our publications page, where you'll find a plethora of information and my contact information as well. So with that, I can turn it back over to you, Eric, and maybe we can sneak in a question or two. So thank you.
Thank you, Amy. Much appreciated. And yes, I hope if our panelists are okay, we may go a little bit over time, just a few minutes. I do want to make sure that at least we get to one question, and each of you has some time to answer. There's definitely a lot of information to share. Also, I appreciate you doing the hard work of putting it all together in a condensed manner. But I think, you walk through a lot of statistics in terms of what has happened over the last few years. Definitely the theme continues to be the economy has been resilient. Inflation, has made some progress towards the 2% target. And while there's some softening in the labor market, it remains relatively solid. So how would you characterize, the economy of your state as you look forward to 2025? What are your expectations? And I'll start with Joe.
Thank you. I'd say fairly optimistic. So there are a couple of reasons for this. In the case of finance, again, this is just speaking very objectively. I'm guessing you have an incoming administration that perhaps has a slightly more deregulatory mindset, and that might advantage perhaps some of the enterprising activity in finance. In agriculture, I mentioned that inflation and the state level inflation, which has actually been quite high relative to national. And the issue there for agriculture has been input prices that are sticky and have stayed relatively high. I think fertilizer versus the price of corn, which you produce. And so to the extent that the disinflation is complete at some point soon, then that inflation moderates on both sides of the income statement, as it were. And then finally, I think as related to that, we have an upward sloping yield curve now. And, you borrow short and lend long, and that's, again, a driver of finance industry profitability. So there, I'm bullish. And then finally, in terms of construction and residential construction and housing and so on, that's all very strong, much as it is for Amy and David's spaces as well. That doesn't seem to be terribly interest rate sensitive. So perhaps that's not going to be the headwind that it might be elsewhere. So mostly bullish.
Thank you, Joe. David, anything to add?
I think that for energy, it's much the same kind of outlook. There's the expectation that it's at some level deregulatory, at some level encouraging. There's a real push there on the energy front, and so I think with that in mind, with some normalcy returning to financial markets, with inflation coming under control, I think there's also an expectation that demand side factors might also push up and improve, that will also then benefit the industry. So from an energy specific perspective, I really see that being a big potential plus.
Thank you, David. Amy, what do you see for 2025?
Yeah, so I think to kind of echo a lot of what they're saying, I think we do continue to project growth. Particularly, we look more specifically at the labor market, and that is more constrained by availability. So looking at in-migration and particularly domestic immigration as a source of labor supply, I think that's kind of our biggest question mark. Will our immigration continue, or will we see a decline in that rate going forward? We would have still expected to be positive, but maybe not quite as rapid, which on the flip side could help address some of the housing affordability and availability issues that we've had in the state. But yeah, just managing that balance, I think, but overall positive outlook for the state.
Sure. And just in the next couple minutes, let's just touch on something here. Overall, there seems to be a positive outlook, I would say, from what I'm hearing from you. What are some of those challenges that we may want to pay attention to?
Yeah,
and
so
I'll start with you. Yeah, sorry. I
okay,
should have said I'll
yeah,
start with you,
sure.
Amy. Yeah.
As I mentioned, the housing affordability and our aging workforce, and then we've seen some declines in our mining and natural resource sectors, particularly recently with the closure of some mines, and so then managing more of those local impacts as well as the statewide impacts in that revenue picture. We are in session as well here, and so that is a topic of conversation among policymakers. So.
Well, thank you very much. And David, what do you think the challenges are?
I think that one of the big challenges will be if there's a return to strength, particularly energy sector strength around the country, and other areas start to grow or benefit. Think Permian Basin, Texas. If there's significant growth there will be a real challenge getting sufficient labor moving up to the Bakken area and exploiting those kind of advantages. And that leads to what we might have seen in 2013, 2014, radical readjustment of people around the state looking for better opportunities. No fault for that. But then it does lead to sort of cascading labor shortages in different geographies and different industries. And so that kind of adjustment situation would be particularly problematic.
And last but not least, Joe.
Yeah, I go back, it's a bit wonky, but that decomposition of personal income, we can't find it in employment, we can't find it in labor force participation. It's got to be in essentially productivity growth. And here, this is not grousing that employers aren't paying enough. It's much, much more profound than that. It's innovation, it's free enterprise, it's diversifying the composition of the economy. It's that sort of thing. And much of that requires perhaps public good production. David mentioned this in terms of state coffers and so forth. Those revenues may not be there, or the will to invest in that sort of thing, understandably, may not be there if the coffers are not full. So I think that's the challenge in terms of labor market diversification and stoking innovation and so forth.
Thank you, Joe. And with that, I want to thank the three of you for your insights, for your ongoing partnership in these sessions. We very much appreciate the time you put to make this happen. And well, with that, to our audience, that brings us to the close of our of this year's. I'm going to share my screen real quick. It brings us to the close of this of this year's Regional Economic Conditions Conference. This event is made possible by you, not just because you are here, but because you are the economy. Our understanding of the economy is more complete if, besides all the available statistics, we also have your thoughts and insights. My colleagues have encouraged you to join our list of contacts. I am here again, reminding you that you still have time to do that. There's a QR code on your screen. Again, our understanding of the economy is more complete if you participate. So please take a minute to become an active partner in this work. Please also take note of the upcoming events on your screen. You will receive more details in a follow-up email, along with the registration links for the manufacturing conditions webinar and the general business conditions webinar that are coming up. Last, at the very end, please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. With that, thank you again for joining us today, and have a great 2025.
Thank you.